Okay, welcome to the June 2025 UCLA Anderson Forecast Conference. We have a lot to talk about today and a very full program. As kind of everyone has observed, things are changing rapidly. There's a lot of uncertainty. We want to dig into that and try and understand it, or at least have a framework for understanding these rapid changes in policy as they unfold in the coming weeks and months. And so we're going to begin our program with the U.S. forecast, U.S. and California forecast. So I am Jerry Nicholsberg. I'm the faculty director of the UCLA Anderson Forecast. And we have on stage the head of our U.S. forecast team, Clement Bohr, and David Schulman, who has a long history, as you know, with the forecast. Not sure what.
Jerry, turn off your.
I don't control that. Okay, how's that? Do you have my lab on? There, that's better. And then David Schulman is going to talk about the state of finance. We have a special guest, Brett House, who is a professor at Columbia University, and he's going to discuss finance and real estate. And our program today is, I think this is the next slide, is joint with the Ziman Center for Real Estate. So we're going to be moving into that. Then we have a keynote, and that's going to be a conversation with Angela Aman, the CEO of Kilroy, and then a panel on rebuilding LA. So a very full program, and I left one thing out, which is Spencer Kalick is going to be giving you a sneak preview as to the results of the latest UCLA Anderson Allen Matkins California Commercial Real Estate Survey. Lots going on, and we're going to turn to that pretty quickly. But before we do, I'd like to thank our sponsors. We're a public institution. We could not do these programs without our sponsors. So they're very important to us, and we're most appreciative of their support. And our sponsors at the principal level today are RSM and Yamava Resort and Casino at San Manuel. At the platinum level, law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Mercury Insurance, and University Credit Union. At the gold level, Alaska Airlines, Avenue Insights and Analytics, Bank of California, California Steel Industries, Hub International, Leap Development, PNC Bank, Robert Half, and SMBC Manubank. At the silver level, Comerica Wealth Management, Marsh McClellan Agency, U.S. Bank, Private Wealth Management, and Wilmington Trust. And at the bronze level, Accutive Security, Federal Home Loan Bank of San Francisco, Hanmi Bank, HDR, PCL Construction, the Port of Long Beach, MBK Real Estate Companies, and Shawmut Design and Construction. And at the Bruin level, Clune Construction, GCX, Illy Commercial Real Estate, and JLL. And if you did not hear your organization's name, please contact us. We can take care of that. This support is really valuable to us. And again, we are very appreciative of our sponsors. So now one other announcement before we turn to the economic outlook, and that is that I have spent the last 19 wonderful years here at UCLA on the faculty with the forecast, the last 8 years as faculty director, and it occurred to me that the time has come for me to retire. And yeah, but there are other adventures in my future. So this is the last forecast that I'll be doing as the faculty director. And thank you. And so I asked AI, because AI is everything today, to give a picture of me to depict this. And there I am, riding off into the sunset with my mushroom foraging hat on. But I'm leading with a lot of confidence in the forecast because, we've been going since 1952. I'm the sixth director of the forecast, and we now have a seventh director of the forecast. And I'm excited about this and, what's to come in the coming years. So the next director of the forecast is Sebastian Edwards. Sebastian's professor of economics here at UCLA, a very distinguished professor, and the Henry Ford Second Chair in International Management. He was formerly faculty director of the Center for Global Management here at Anderson. So we are in good hands with Sebastian, and here he is. This is AI's version of him writing in from the sunrise to the new era of the seventh director. And Sebastian wouldn't let me quite go away. So he turned my horse around and I'm going to still be doing the California forecast, which I'm going to be talking about today. You won't see me as much, but you still will see me a number of times each year, and I'll still be actively involved in the forecast, just at a different level, a similar role, but some of my roles have gone away with the retirement. So again, thank you for all of your support and kind words over the years. And so I think that's enough with economists riding horses. Let's find out what's going on with the US economy, and let me turn it over to Clement.
Thank you, Jerry, and good morning, everyone. So there has been a dizzying amount of economically relevant news over the last couple of months. In fact, often not a day goes by before another major event or announcement takes place. But before we get there, I want to quickly recap and review you guys how the economy's done over the last couple of months from the beginning of this year. So what I'm showing you here is the 2025 Q1 GDP report, which had a lot of headlines because it showed that GDP actually contracted by 0.2%. And if you look, I'm showing you GDP growth at a quarterly rate all the way back to 2022. And if you notice this 2025 Q1, it looks a bit different from the other ones. So I've decomposed that real GDP growth rate into three components: core GDP, which is all fixed investment and consumption expenditures, both private and public. And then the more volatile components of net exports and change in inventories. And what you see in 2025 Q1 was a dramatic, huge negative component in net exports. That is a huge surge in imports, reflecting people and businesses trying to import their goods before the tariffs take into effect. And so that's why we had this last GDP report look so different and unusual. And that's also why most economists were not that concerned about having this headline growth contraction, considering how unusual the report was. You also see the large yellow bar that's positive, then increase in the amount of inventories. That's again firms bringing in a lot of inventories before the tariffs take place. So one way to get around these headline numbers, to get a good understanding where the economy is just to focus on the less variable core GDP part, which are the gray bars. And there you see is that in 2025 Q1, we grew at a healthy about 2%. So a bit weaker than the last 2 years. You see that gray bar is a bit lower, but overall, not a contraction by far. However, if you go even deeper into that core GDP and see what made core GDP grow by 2%, 2/3 of that came from investment-related expenditures in AI, both IT equipment and software and the likes, right? So that actually means that if you take out these large surge in AI investment expenditures, even core GDP was very weak. There was very little investment growth on net in the rest of the economy, as well as very weak consumption growth. So the further you dove down, actually this GDP report was not very strong, even though for quite different reasons than what the headline rate showed. Turning to inflation, to really understand where inflation is and where it's headed, we still have to go back and look at the entire picture going back before the COVID-19 pandemic, because we're still in many ways reeling just slightly from the aftermath of the COVID-19 pandemic. And so similar to the last graph here, I'm splitting up the volatile inflation components that are the blue and yellow, that's goods, food, and energy, which are stacked on top of each other. And then separated from that, I have split the less volatile components in, which are the dark and light gray of the cost of shelter and services inflation. And what you see is that the COVID-19 pandemic, due to the supply chain crises and disruptions that emerged, we had this large surge in the volatile components starting in 2021. And by mid-2023, most of that had abated. However, the gray parts, which are much more rigid prices that update and adjust much more slowly, only peaked around 2023, and they've only been declining slowly ever since, again, because they are so rigid, right? A lot of rental contracts are only updated 1 or every other 2 years. And then also the labor market was very strong after the COVID-19 pandemic because of the fiscal stimulus, that there was very little downward pressure from the wage side as well. And so if you imagine you just drew a trend line on that gray downward line after the initial surge, you see that we would actually approach our 2% inflation target within a year, right? Unfortunately, we're not expecting that to happen, right? So that takes us to the Trump shock of what has happened over the last couple of months. And the first, and it goes without saying, is the primary thing here are just massive tariffs, right? And I mean, even after the de-escalation of the trade war with China, with the tariffs coming down from the 150% to the 30%, and even including the pause in the Liberation Day tariffs, what we have now are still exceptionally massive tariffs. And David is also going to show you a picture of that later. Okay, we have 50% tariffs on steel and aluminum. We have 30% additional tariffs on the tariffs that already were in China before this incoming year. We have 25% in car parts. We have 25% probably coming in copper and lumber, 50% incoming on steel appliances. So the list goes on. These are very large numbers. Okay, and on top of that, a lot of these tariffs have been implemented in a very haphazard way, and that's caused real harm to the economy. Here I'm highlighting just two of the main scenarios that's happened. First of all, there was a brief sell-off in the Treasury market after the announcement of the Liberation Day tariffs, right? We saw a 50 basis point increase in the 30-year Treasury rate in one day, which made markets freak out. And that's why President Trump, paused those tariffs, because there was a real concern that there was an unraveling in the financial markets that would lead to some sort of crisis there, right? That was very damaging at the moment. And the other example I have here is the brief decoupling from China due to the trade war, where we had those tariffs above 100%, which basically severed all trade for about a month, right? So even though we've de-escalated from that, some of that damage is done. And when you add to all of this haphazard and very large tariff policy, we don't really know where it's going, because they're not quite clear in the direction of where it's going to settle, but also a lot of these policies have uncertain legal foundation, right? We already saw a court deemed a lot of these tariffs that are implemented under the International Emergency Economic Powers Act unconstitutional. Then we saw another court pause that ruling. It's going to head to the Supreme Court eventually. We just don't know where these tariffs are headed in the short and in the long run. Okay, and so that's leading to a lot of policy uncertainty. And then lastly, on the fiscal policy side, which I'll talk about in the next slide as well, this fiscal policy is really looking quite irresponsible for the fiscal image of the US government and the sustainability of that going forward. And it's also very uncertain there what they're actually going to be able to push through government, because they have, on the Republican side, a razor-thin majority, and they're trying to push through a package that there doesn't seem to be any majority for at all. So it's very unclear what's going to happen there. And so that's why I'm showing you this figure on the right, which shows you measures of economic policy uncertainty, both for trade and fiscal policy. And you see that they've both surged to just unprecedented levels, right? And the one way you can see it's unprecedented is that you see the spike in fiscal trade policy uncertainty during the COVID-19 pandemic. Well, just recall what an unprecedented time and uncertainty that was. Nobody knew what was going to happen at the beginning of the COVID-19 pandemic. And we're far beyond that level right now. So turning to the US fiscal picture, right now, the US is on an unsustainable fiscal path. Last time I showed you a trajectory for the US debt as a percentage of GDP. It's currently 100%, and it's only projected to rise. Here, I'm going to show you a slight different way to depict what's happened and what's gone wrong by showing you how the government's fiscal deficits move with the business cycle. So the government fiscal deficits are in yellow, and the business cycle, here I have a measure of the unemployment gap in blue. And what you see is that when the unemployment goes up and we go into a recession, fiscal deficits increase because tax revenues fall, and the government usually, produces fiscal stimulus to support the economy. Then when unemployment falls and the economy begins to do really well, tax revenues rise, and we don't have to stimulate the economy and support it as much, so the fiscal deficits go down. And you even see in the late 1990s, the fiscal deficits went actually into a fiscal surplus, which brought, helped reduce the debt at that time. And so that pattern has been very consistent until 2016, where you see that the fiscal deficits disconnected from this cyclicality. Even as the economy was booming in the late 2010s under the first Trump administration, fiscal deficits started rising rather than falling. And you see that they've just continued to rise on an upward trajectory regardless of how the economy is actually doing. So this is completely unsustainable from a fiscal debt path. Which then brings us to the current tax bill that Republicans are trying to push through the Congress. And what you see with that tax bill is that it does nothing to help this fiscal picture. At best, it is neutral, but more likely it is actually only going to add much more debt and worsen the trajectory of this future fiscal path. So right now, the estimates are somewhere between 3 and 5 trillion in additional US debt over the next 10 years. You might see, okay, well, what's going to counter that? Well, it's not going to be DOGE. The DOGE savings are very small, only about 150 billion. And it's also very uncertain how much of that's actually going to be realized, because they are not very transparent with that. And whenever they do post these savings, they're often inflated or it's not quite clear how much is actually going to be realized. The tariff revenues, however, are substantial. Okay, so right now, by month, we're bringing about $200 billion in tariff tax revenue. And so if you extrapolate that over 10 years and you have some reductions in imports, which is going to lower that, we're going to see tariff revenues of about 1 to 2 trillion over 10 years. Okay? And so that is substantial. It's going to help nullify a lot of this increase in the tax bill otherwise. But it's important to note that we don't know where this tariff bill, where these tariff policies are going to go in the future. And we cannot, rest assured on the fact that we're going to have these tariffs over the next 10 years. We don't even know where they're going to be tomorrow. And so if you want to put that in and account that in the fiscal picture, they should put it in the actual bill and make it part of the bill to account it for, right? Another 2 ways that the picture is actually worse than what I've said here is that these projections so far have been made under interest rates that are lower than what's actually right now happening, because we've seen a large rise in interest rates over the last couple of months. And it's only projected to, we're going to maintain a higher level of interest rates going forward. And then also, these projections do not include a slowdown in economic growth over the next year or two, which this tariff policy is also supposed to, or most likely to, inflict on the US economy. So in many other ways, this picture is actually rosier than what's actually going to be let on. When it comes to the effects of this tax bill, we expect it mostly to be neutral, maybe a little bit of a fiscal boost. And that's because even though it's so large, most of it's just tax cuts, extensions on high-income earners. So that means that it's basically the status quo of what we have now. Okay, so it's not going to be a large difference. There are some new tax provisions, such as the tax cuts for elderly on Medicaid and SNAP. Some investment expansion for R&D and manufacturing construction, as well as interest loan deductions on cars. But these provisions are fairly small relative to the rest of the package, and they're only temporary. They're going to expire in 4 years. On the other hand, we have deep spending cuts to Medicaid and SNAP, and removal of a lot of the investment subsidies for clean energy and the likes that were put into under the previous administrations. And those are much larger and permanent. They're going to counteract that additional boost from the others. So, on net, this is not a very stimulative bill. And so given all this economic policy uncertainty, what does this mean and how are financial markets behaving? And the way they're behaving really shows you that this time is very different from past times. And the way I'm showing you that is I'm going to compare it with you how the dollar has responded to the last couple of months and how the 30-year interest rate on US government debt has responded And compare that right now and compare that to the global financial crisis and the COVID-19 pandemic, okay? And what you see and what makes the US have this exorbitant privileged behavior is that when in moments of crisis, as you see in the first two plots, investment flows into the US because we are the rock and the stability of the world. And so the value of the US dollar rises and interest rates fall. And that's a huge boost to the US economy. It's a huge benefit because that means we can fund the government and borrow really cheaply in the most dearest times of need, right? When those interest rates goes down in the most, in the worst cases, that's incredibly beneficial. Now, when you compare that in the third plot, you see the exact opposites happening right now, right? Investment is being rotated out of the country. And so usually you see, and what that means is we're going to having a decline in the value of the dollar at the same time as a rise in the interest rates. So it's going to become more costly to finance our government debt, and it becomes more costly to import as well. So it's been a lot of talk comparing this to emerging market-like behavior and capital flight. That's a bit extreme. We are seeing a rotation of assets out of US markets, but it's on the margin. It's not this, run on US government debt. So that turns us to the outlook for the US economy and where we see it going. And we're going to start with unemployment. We see unemployment rising to 4.6%, so a moderate rise in unemployment over the rest of this year, peaking in 2026 Q1 and then moderately declining after that. And this is on the back of the large tariff costs, which is going to contract and hit the manufacturing sector. Their inputs are going to become much more expensive, and that's going to make them much harder to compete and produce at a cost-effective rate. We're going to have reduced trade, and so all the sectors in the economy, such as retail, wholesale trade, and the logistics sectors, they facilitate that trade activity, and that trade activity dries up. That's going to be a big hit to these sectors of the economy as well. And then more broadly, the level of uncertainty we have right now paralyzes any investment in hiring decisions. We have higher interest rates, which crowd out investments because it's just too costly to finance new investments. And then we also had this surge in inventories due before the tariffs hit, which means that now these inventories have to unwind, which is also going to be another drag on the US economy. And we also expect after this next quarter inflation to moderately rise and just exceed 4% for its headline rate. That's, as I mentioned, we still have slightly elevated services inflation rate, but most of this is coming from the tariffs and the weaker dollar, which is going to make imports much more expensive. At the same time, we have some downward pressure from a weakening economy. We already see this in reduced air flight prices. And up until last week, we also had much weaker oil prices, which helped bring down the cost of energy. Now, I said as of last week because that picture has completely changed since last week, right? So we put this forecast together before the start of this new war between Israel and Iran. And so our oil price forecast that we have in this forecast have oil prices remain around $60 to $65 per barrel. Obviously now I think they're about $75 per barrel. That's the last time I checked yesterday. And it's very uncertain where that's going to go. If this breaks out into a larger conflict than it already is, oil prices could go much higher. If Iran closes down the Strait of Hormuz, that's going to could make oil prices go much higher. But it could also de-escalate and we could see a moderation in oil prices, right? So there's just a lot of tail risk there. We don't know how that's going to unfold right now. So after the spike in inflation, we do expect it to moderate fairly quickly. And that's mainly because the underlying economy is going to be slightly weaker under that. So there's going to be very little upward inflationary pressure that's going to keep that inflation high. And right, so we have rising unemployment, we have rising inflation. That puts the Federal Reserve and their interest rate setting in a very tricky spot, right? Higher unemployment would mean that they should lower interest rates to support the economy, and higher inflation means that they should raise interest rates to tamper that inflation. So they're in a very tough spot. We therefore believe that they're going to keep interest rates where they currently are until the first quarter of 2026 when they're going to start cutting. We think they're going to lie and focus more heavily on their inflation mandate because they're extra sensitive to that mandate after the surge in inflation during the COVID-19 pandemic. And we still see now in opinion polls that the most important policy for voters and for the general public is prices and inflation. And so that mandate is going to take preeminence. But following 2025, we see 2 cuts in 2026 and 2 cuts in 2027 for now. For longer term interest rates, such as the 10-year yield, we see it rising over the rest of the year, even though it's already risen a lot. And that comes along with this surge in inflation we're going to be seeing over the summer and the fall. But then after that, we're going to have it come down with the fall in the short-term interest rates. However, because of this rising risk and term premium for investing in the U.S. economy, we don't have it falling as much as short-term rates, and we have it remaining above 4%. So that is that higher interest rates are really here to stay for the long run, unless we really have some deep crisis and the economy bottoming out. And so that gets us to the final statement, which is that right now we do not foresee a recession for the U.S. economy. That is not what we have forecasted, but we do have forecasted a real slowdown in the GDP growth to the point where it's almost going to come to a stall towards the end of this year. Right? And so that is for all the reasons I mentioned earlier, such as the tariffs, the uncertainty, the interest rates, the higher interest rates, and the buildup in inventories we've had so far. There is one counterpoint to this, which I mentioned in the first slide, which is this very highly elevated level of investment expenditures in AI, and that could really be a strong tailwind for the U.S. economy over the next couple of years going forward. By 2027, we expect growth to mostly recover. There is still going to be significant headwinds at that point because we're going to have a lower, for instance, we're going to have a lower labor supply growth due to the higher level of deportations and much lower levels of immigration into the economy. These higher interest rates, which I just talked about, are going to continue to drag on the economy. However, on the flip side, we have, hopefully by then, real productivity gains coming from artificial intelligence being incorporated into the U.S. economy, as well as a boost in growth from various deregulation policies, both at the state and local as well as the federal level. So, but one thing I should mention is that you see that even though we don't have a recession projected, we're getting close. And so it doesn't take much to tip us over the edge, right? So if there is a real conflict between Iran and Israel, or that becomes a larger conflict, or other unforeseen circumstances, you know, we're not quite at the edge, but we're pretty close to the edge. So to conclude, you know, the Trump shock is here, and so expect higher inflation and lower growth in the near term, especially over the rest of this year. But take this forecast with a grain of salt. Okay, there are huge uncertainties and risks to this forecast. I don't need to mention that, you know, the tariff policy changes day by day. We don't know where this is going to end up. As we saw last week, the geopolitical situation and the tensions around the world are very high, and there are a lot of conflicts that could arise. And then lastly, there's also a real concern for financial instability because, as I mentioned earlier, we already saw a brief sell-off in treasuries back in the beginning of April. And of particularly concern here is if the current administration starts to target the independence of the Federal Reserve more forcefully than what they have done so far. So right now, we do not have any projection included in our forecast that there's going to be a real imposition against Federal Reserve independence. But we see the attacks from the president on Jay Powell, and we see, you know, we see his advisors talk about potentially finding ways to replace Jerome Powell. And we also see them talking about nominating people like the current treasurer, Scott Bessent, to you know, succeed Jay Powell, which would not give market confidence necessarily because that may be seen more as a political nomination than a credible, independent, nonpartisan nomination. So there's a lot of uncertainties and risks going forward. Okay, thank you.
Thank you, Clement. This went on. Can you hear that? Yes, great. And you know, as sort of muted as the U.S. forecast was, the U.S. forecast was actually fairly positive given all of the things that are going on. And part of the reason was that the U.S. came into 2025 with a very strong economy, and there's a lot of inertia there. That's not true about California, and that's why I have this California slow walking economy. In the fourth quarter of 2024, California real personal income grew at only half of the US. Usually it grows at much faster than the US. And in the first 3 months of this year, payroll jobs in California decreased by 50,000 jobs. So we're starting off with a weaker economy in California than the US, and the same factors that buffet the US economy certainly buffet California, because California is 13% of the US. So I've showed you these pictures in the last two conferences, and the issues are still the same: trade wars and deportations. And so where we're going today is we're going to look at employment and what's been happening in employment, and where might we find growth in California in 2025 and beyond, and then digging into some of the sectors that are going to be important: the tech sector, Hollywood, logistics, and housing, and then on to the forecast. So let's jump right in and look at our metrics of employment. So you see two lines here. The blue line is from a survey of households. It's a small survey, 5,500 people are asked in this state of 40 million people. But this is where we get our labor force estimates from. It's where we get our unemployment estimates from. And it is by domicile, is where people live. So a tech worker who lives in Boise but works in San Francisco remotely is in the Idaho blue line, the Idaho labor force, not in the California labor force, right? But this includes gig workers, 1099s, independent contractors, self-employed, so kind of includes everyone. The red line is payroll employees. So it's payroll employees only. It doesn't include those independent contractors and the like, but it's an enterprise survey. It's where the enterprise is located. So that Boise remote tech worker is counted in the red line because they're employed in San Francisco. And what you notice here are two things to notice. One is that there's a big difference between the two. And that's because California is historically an entrepreneurial state, and the two lines kind of parallel each other. The distance between the two has shrunk because of all the folks that dropped out of the labor force, that retired at the time of the pandemic, and you see kind of the big drop and they come back. The blue line's just about back to its pre-pandemic peak. The red line is 350,000 jobs above its pre-pandemic peak. But if you look on the right-hand side, let's focus on the red line here in the payroll employment, it's flat. So through the first 4 months of this year, and last month, the Bureau of Labor Statistics reported an addition of 17,000 jobs in California, but the first 3 months was minus 50,000, right? So that's kind of the slow walking economy. Let's look at this by sector and see kind of what was driving the growth that we got in 2024, what might drive the growth in 2025. So this is April 2024 to April 2025. And if you look over on the left-hand side, we have healthcare, education, state and local government, logistics, a little bit from farm, and then everything else is flat or negative. And these ones on the left-hand side, healthcare, education, state and local government, kind of the big drivers of the last 12 months, they don't have legs to them. So what I want to do is annotate this with where policy is going to bite by sector. And so I'm going to do that with some letters: I for immigration policy, B for budget, so that's going to be federal as well as state and local, T for tariff, and then I have an asterisk there, and the asterisk is to indicate where policy might have been modified. So let's start off with healthcare and social services. That's both immigration policy and tight budgets. And you heard about the budget bill that is working its way through Congress. That doesn't really have legs. That's not going to support growth. Education, similarly, immigration and budgets. State and local government is budgets. And then we have logistics, which is tariffs, and we want to dig into that and see to the extent to which tariff policy is going to affect our logistics industry. Farm is I star. So the latest pronouncement is that ICE is not going to be going to the farms to pick up people, but it doesn't say that they're not going to be picking up people in, say, Oxnard or Salinas. So those farm workers are still at risk. The undocumented farm workers are still at risk, just not when they're in the fields picking strawberries and lettuce. And the real question, and we don't have an answer to this, is to what extent are they still fearful of being detained and they don't go to work? To what extent do they believe the government that they're not going to have raids in the farms? So this is still an open question as to the economic impact of I-STAR versus just the normal I. And then we've got other services, immigration. We've got retail and wholesale trade that are going to be affected by higher prices due to the tariffs. Non-durable goods manufacturing, that's an I-STAR. So that's where the slaughterhouses are in food processing. And then we go to construction, and that is tariffs, raising the price of building homes, as well as immigration policy and the labor force there. And then we've got leisure and hospitality, also I-STAR, possibly changed immigration policy. And durable goods manufacturing, that's going to be affected by those input price tariffs. So if you look at this, it doesn't give you a lot of warm feelings about what's going to happen in the state going forward. So we want to look at manufacturing, we want to look at tech. So, you know, tech, I didn't have any annotation for. We want to look at Hollywood, which is part of the information sector. And Hollywood was responsible for half the differential between the US unemployment rate and the California unemployment rate. So is that still going to be a drag on the California economy? And we want to look at logistics. We want to look at construction and housing. So we're going to look at these by sector. And first thing that we're going to do is look at where's the unemployment rate going to go. It's kind of ticked down to about 5.3%. And some of that is the return to work with people who are working remotely. Our friends in Boise finding that they had to be back in the Amazon office every day and moving back into the state. Because remember, unemployment comes from where people are domiciled. And so they come into the state, but they come into the state employed. But we have, as with the US forecast, an increase in the unemployment rate. It's a little weaker than the US by about 3, that is the increase is about 0.3 percentage point, because California started out with a weaker economy, goes up to 6.1%. But the factors driving the US economy into 2027 with tech and AI, we've got that really taking hold in California, because that's disproportionately California economic activity, and the unemployment rate getting down to 4.1%. So near-term unemployment going up, but the longer term actually looks fairly positive. So let's look at manufacturing, and this is from 2018 to the last numbers we have at the end of 2024. Through 2023, real output in manufacturing in California grew by 28%, but then it fell off with the closing of a number of factories throughout the state, and particularly in computers and electronics. And so it's only about 14% above 2018, but you see it's kind of flat there. And in fact, in the first 4 months of this year, we lost in California about 1% of all manufacturing jobs in durable goods manufacturing. So that's still a weak sector. We are expecting growth. And we're expecting growth for 2 reasons. One is in the aerospace industry. So Boeing is going up in rate, Airbus is going up in rate, and they demand sophisticated components that are manufactured in the state. The second is increase in demand for defense durable goods, disproportionately California activity. And the third, space, and so that's launch vehicles and satellites and the like, also disproportionately California. So that's going to be growing. The other thing that's going to be growing is that we have a fair number of new factories that are going to be opening up. We thought in 2025, but the slowdown in the US economy, maybe 2026, and they'll be hiring. So we're going to get growth in manufacturing in the state. Is it going to be enough to kind of turn this around in 2025? Well, manufacturing spools up fairly slowly. So growth, not dramatic growth until we get out into late 26 and 27. Turning now to tech, now there isn't a tech sector per se, but there are 2 sectors that are heavily tech. And this is one of them, professional, scientific, and technical services. You see the pandemic there, and then it rises to a peak, and then all the layoffs that you heard about with respect to tech companies, the big tech companies, you see that in the drop. and then it kind of flattens out. But there have been recent announcements about further layoffs in the tech industry. And you see the same thing in computer tech, which is in the information sector, along with Hollywood. So both of them seem to be kind of weak going into the rest of 2025, but we are expecting growth in them because with a smaller labor force, with higher cost of labor, there's going to be a demand for labor-saving equipment and software, and in particular, the uses of AI in doing that. And so that's going to be driving these two sectors and some other sectors in California as we get out into 2026. And because of AI, we are much less worried about California. So you hear a lot about AI is going to replace all of these jobs. And it's true, AI is going to replace employment in many places, but disproportionately, AI is being developed in California, and that creates jobs for AI developers. The real issue here is these coders who were laid off in the tech sector, can they obtain the skills to be AI developers? Or is that going to be somebody else? And so we don't know the answer to that question, but we do expect this in the aggregate to be a growth sector and a pretty robust growth sector. Now, California grew much faster than the US in the first part of this century, actually up until last year. And that was driven in large part by the robust tech sector. That's what we're expecting to happen again after we get through kind of the bumps in the economy right now. This is Hollywood, and what is, so what you see here going from left to right is an increase in employment in Hollywood. That is all of the content for streaming. You know, when you turned on your TV and you saw all of these shows, and at least when I looked at it, I go, I don't know how to make my decision, and turned it off, right? That's all those people producing content. That's not a sustainable business plan. And so, you know, you have the dip there when no content was being produced because of the pandemic. Then there's a recovery from that. But what is important here is that shaded gray line. That is the dual strikes. That's the period of the dual strikes. If you look at labor actions kind of through history, what you find is that because labor actions are not unexpected events, everyone knows they're coming, you have prior to the strike, you have a stockpiling of product or of services. You have a stockpiling, then you get the strike and you move along in the strike, and the workers use up their savings and the employers use up their inventory, and then they start negotiating. They end the strike, and then they go back to work, but they work extra to make up for the lost production. You don't see that here. Why don't you see that here? Because Hollywood's restructuring, producing less content, and it seems to have flattened out. Now, some of that is runaway production, but certainly not all of it. And there's a bill in the state legislature to increase the subsidy for California-based production of movies and TV content and streaming content. That may raise that a little bit, but the important point here is in the information sector, this was very much a drag, and that's why that information sector was that red block below the line. It's no longer going to be a drag on the California economy, so that's kind of the good news here. We don't expect a lot of growth, but we don't expect much in the way of decline. Moving on to logistics, what you see in this graph are the seaports on the West Coast. The top line is the massive seaports of Los Angeles and Long Beach combined together. And they're so large, they're the largest seaports in the Western Hemisphere. And so they're on a different scale on the left-hand side. And then it's the Puget Sound, and then basically Oakland is the San Francisco Bay. And as you look across here, so there are two things to notice. One is 2017, 2018, which is right in here. And that's when during the first Trump administration, when tariffs were put on. You can't really see a lot of impact of tariffs there. And then the second is if you move over onto the right-hand side, a big surge of imports. But that's to get goods into the country prior to the tariffs. It started falling off. The reports of the number of ships that are on the Pacific headed to the US is way down. And so what you just have here is not what the graph might suggest kind of on superficially, but rather a shifting of goods through the ports from the future to the present. So we're not really expecting much in the way of support for growth in logistics. And that was one of the growth sectors in the last 24 months going forward. Now, looking at other goods movement on the left-hand side is air cargo through LAX. It rises to a peak. It's been flat. Part of the reason is we have many fewer flights from China now, and so there's much less belly cargo space. And that's been decreasing as we have fewer flights now from Canada as well. On the right-hand side, though, and this is kind of concerning, this is domestic air cargo. On the top is Ontario and LAX, and on the bottom, SFO and Oakland. And it's kind of been declining. So we've got real weakness in goods movement supporting logistics. But when we look at logistics employment versus movement of goods, what we find is there's some correlation, but not as much as you would expect. So the top line here is goods movement, TEUs, those are containers, goods movement through California's ports. The bottom is California's logistics employment. And if you look at the trends are kind of different, right? And what's really dominated logistics employment has been the shift from shopping in stores, where the store has its inventory there and not in a warehouse, to shopping online, or shopping in a store where the inventory is held in a warehouse. And the warehousing and the trucking is the logistics employment. That's what's dominated this. And so we find when we do the statistical analysis, there is an impact of the cutback in goods movement. It's primarily an impact in terms of hours worked as opposed to number of people. So it has an economic impact, to be sure, as these folks have less income. But as the economy grows, slowly this year, the US economy, faster in coming years, we get more and more demand for logistics in the new way in which goods are produced and distributed. So this is a sector that we've got slow growth in, but we do have growth. It's not imploding because of the tariffs. And then turning to housing. So you look on the left-hand side, this is sales of existing single-family homes in California. It's at depression levels, it's staying there. We boomers are not selling our houses. We have 3% mortgages, we're keeping them. And so the inventory is low, although the inventory is increasing because people do have to sell their houses. Although keep in mind that the stock of housing in California after the December and January wildfires has shrunk, actually. Right-hand side is California median home prices. Other measures of home prices show the same thing, kind of record levels. So we have high prices and low inventory, right, in this market. So that should suggest we're going to get more construction. And in spite of the headwinds, we should see an increase in permits for construction, but that is not what we see. If you look on the right-hand side, number of permits being issued for residential construction is going down, not up. And so you get higher prices, relatively low inventory. What's going on? There are kind of four major things that are happening. One is uncertain costs. Builders don't know what lumber and drywall and electrical fixtures and cement is going to cost as they build homes, so they don't know if they're going to make money or not. So the projects that have high margins, you can live with margins being squeezed, but those marginal projects, they're not getting done. High interest rates is keeping consumers away. Labor shortages, you don't know if you're going to have a labor force to build those homes once you started, and there's price uncertainty. So there is anecdotal evidence that buyers are holding back because they're seeing soft markets. They're expecting lower interest rates, and they're expecting prices to come down. And they have a lot of uncertainty about their jobs. And so they're not going into the market buying. And if you have on the demand side, the demand is moving to the left. And on the supply side also ends up moving to the left, because developers can't make business plans as they can in a much more certain environment. And potential buyers can't make plans that they would have made in a more certain environment. So we have some growth in construction. And when we get into 2027, a lot more, but not much this year. And so what we have in our forecast is negative employment growth this year, but positive income growth. So it's kind of skirting along. Now, we don't have a real definition of a recession for a state, but this is kind of recession-like, because we have employment actually contracting a little bit this year. Manufacturing and tech are going to drive California growth in 2026. Finance, agriculture, construction, leisure and hospitality, all a question mark. So still a lot of uncertainty of what policy is going to do. And 2027, a return to superior growth faster than the US, led by manufacturing and tech. We still have our risks, size and timing of deportations, more extensive tariffs and retaliation. Importantly today, obviously, geopolitical and disruption in the federal government. And, kind of the latter has to do with things like how much money is going to be available for Medicaid. In Sacramento, a budget has to be passed in the next 12 days. And they don't know how much money is coming for Medicaid, so they really don't know how to do this. So this kind of uncertainty really weighs on the economy. So some numbers here. Minus 0.1% is not much, but it is negative in employment growth this year. But then as we get out into 2027, we start getting, again, superior growth. Unemployment rate averaging 5.8% this year, then 5.6, then down to 4.4. And as you see, we only have 100,000 new homes being built this year. You net out the homes that are lost in the wildfires, and we have very little addition to the housing stock. So, in that sense, no relief on price, no relief on affordability, and it grows slowly. It grows slowly because there are a lot of headwinds in construction, as we've talked about. And so that brings us to the end of the California forecast. Thank you. And now we're going to turn to David Schulman. Welcome back, David, who is going to talk about the financial landscape. And we've said a lot about tariffs. Now we're going to dig into that more deeply. David, over to you.
Okay, thank you. I have several main themes to talk about today. Most important is the post-war era of international cooperation, which started in 1944, is over. Controversy over tariffs in the light of long-term American history is nothing new. What we've been living through for the past 40 years is the exception, not the rule. The markets don't believe the president on tariffs, but tariffs are here to stay because the government needs the revenue, as Clement mentioned. So there'll be a lot of revenue from tariffs. Just remember, a tariff is a tax, so it's a tax on everybody. The weak dollar signals selling of US assets. As Clement said, federal deficits are at unsustainable level. Interest rates will remain at or near current levels. I don't see a hope. The Fed meets today, unlikely they will do anything, even though the president did another harangue against Chairman Powell this morning. And it's also hard to make a solid bull case for stocks given where valuations are. So those are the main things. The New World Order is that the post-war architecture has collapsed. In 1944, there was the Bretton Woods Agreement, which basically talked about monetary cooperation among the major powers. I don't see that, even though we had a G7 meeting in Canada. 1947 passed GATT, General Agreement on Trade and Tariffs, which is trade cooperation among the major countries. That's clearly over, and it's lack of cooperation. 1949, NATO was formed, and military cooperation seems to be almost gone. So what we're in a totally different world, and I think that's going to affect risk levels for all assets. So the world is, in my view, is a lot riskier place than it was 6 months ago. Deglobalization is in process. It's going to lead ultimately to higher inflation and lower growth. And we're moving from a post-war world to maybe a pre-war world, because the post-war world is over. And so this could be 1933, 1934 right now, on that, when the post-World War I world ended. Okay. Tariff controversies are older than the Republic. We had the Boston Tea Party was a tariff on tea prior to the Republic. Congress in its first term, the first year of Congress passed the first Tariff Act of 1789, and that was mainly to fund the government. The government was funded historically by tariffs, excise taxes on tobacco and alcohol, and selling land in the West. There was a protective tariff in 1816. In 1828, there was something called the Tariff of Abominations, which John C. Calhoun wanted to talk about nullifying federal power, and it became a proxy war for slavery. Today, we have the same kind of thing where the governor of California wants to nullify federal power. There's a Morrell tariff, the protection tariff in 1961, plus funding for the Civil War. McKinley tariff, which got up to 50% tariffs. Underwood tariff, and that was really important because the Underwood tariff lowered tax rates, huge reductions offset by income taxes. So that's when the income tax came in. The income tax then substituted for tariff revenue. So we're basically going back to the 19th century, basically, what we're doing now. We had the Fordney-McCumber tariff, the famous Smoot-Hawley tariff, and there's a whole series of tariffs. And basically, we've been in an era of free trade, and that's started to buckle a little bit in 2002 with steel tariffs. Then we have Trump tariffs 1 in 2018 and Trump tariffs 2. But here's the history. Tariff abominations, 55% tariff, Morrell tariff. Then we had an era of free trade in the country. Then we had the Morrell tariff, pay for the Civil War. This big drop in tariffs right here in 1913, this was the drop in tariffs. And we had income taxes was substituted for tariffs. That was done by President Wilson and the Democrats, and then Republicans came back in, put tariffs in 2022, and then Smoot-Hawley, 1930. And then since then, we've been going down. Basically since 1934, when President Roosevelt put in reciprocal tariffs, all of a sudden, we're making separate trade deals with each country. Back in 1934, the goal was of reciprocal tariffs was to lower tariffs. Today, the role of reciprocal tariffs, when Trump announced it, was to raise tariffs, basically. So that's the difference. And we've been in a world where tariffs are basically 2%. Hardly noticeable in anything. We had a couple of things on steel, a couple of quotas on autos, but basically, we've been living in a free trade world, basically from 1947 on. We're gradually lowering tariffs. So nobody ever talked about tariffs or thought about tariffs. And then we have the Trump tariffs, April 1st, going up 10%, and the big gain to 25%. Now it's around 15%. So this is sort of the recent history, 10% on tariff, then to Mexico, Canada, pausing it, but the average rate is 15.5% right now. So that's sort of where we're at. This is a monumental change to trade policy in the United States. And we haven't had this since 1931, 1932. Now, the Wall Street believes we have a taco trade. And the taco trade stands for Trump always chickens out. And that phrase was called was coined by Robert Armstrong of the Financial Times. But basically, Trump announces a tariff, big giant tariff, pulls back, announces all kinds of big tariffs against China, pulls back. So the markets don't believe Trump on tariffs. Now, one of the tests are going to be, Trump is talking really tough on Iran right now. So the question is does Trump chicken out on bombing Fordo? He's talking about bombing Fordo. If he doesn't chicken out, the market all of a sudden is going to really believe Trump on tariffs. Markets don't really believe him now. That'll stay that high, but that's a big question. And the markets right now are assuming we'll end this whole controversy with 10% tariffs on everybody, probably a 30% tariff on China, and there'll be high steel and aluminum tariffs. They may not be the 50% that they are right now. 50% tariffs on steel and aluminum is called the Destroy Canada Act of 2025, because we get half of our aluminum from Canada and 20% of our steel from Canada right now. That's going to have a big impact on costs here and domestically. And the day will come, we'll see if the market calls, Trump calls the market's bluff. Here's the revenue. Very low revenue, $5 billion a year, something like that, $4 billion. Run rate, up to $22 billion in May, came in revenue. You annualize that, you get like $250 billion a year. That's $2.5 trillion over 10 years. Goes a long way to deal with all the deficits that's in the budget bill. So we're talking about a lot of money here. And the United States imports $3 trillion plus a year in goods. If you want to put 10, 12% on that, you could get $300 billion a year coming in from tariffs. So there's a lot of money. There's really a lot of money involved. It's not small. And the thing is in my view, is we haven't really seen it yet, but my guess is we will start seeing this. This is just too much money involved that we will be seeing it in terms of prices. All right, here's the other things happening is, and Clement talked about it, is the dollar has fallen out of bed. It's down 11% since January. And the dollar's continued to decline. This is plotted through the first week in June, and dollars continued to decline. Here's the breakdown between interest rates, the 10-year Treasury yield, and the dollar index. And basically, you see is they're in parallel all the time. Rates go up, dollar goes up. Rates go down, dollar goes down. All of a sudden, dollar collapses, rates stay up. So basically, there seems to be less trust in the United States, and there seems to be an exit from US assets going on by the rest of the world. And 18% of US stocks are owned overseas. In the year 2000, the beginning of the century, only about 10% of US stocks were owned overseas. So the buying from overseas has been one of the major forces for elevating stock prices here. My guess is this certainly won't continue to grow. And in fact, it may decline. If it goes from 18% to 15%, it will be noticeable. The other thing is, in the tax bill is Section 899. Section 899 basically is a revenge tax. If Europe or France puts a digital tax on American software, Netflix or what have you, the Secretary of the Treasury could put a 5% tax on investment income from the United States going to France or Germany or wherever, and that could go up each year to 20%. Wall Street is scared, really scared about this. Because basically is what's the incentive? If this gets imposed, what is the incentive for Germany or a German citizen, a French citizen, British citizen, Japanese to buy US assets if all of a sudden they could be subject to a tax on the income from that investment? That's in the bill right now. And the Senate bill has that taking effect in 2027. The House bill has it taking effect next year in 2026. So that's in there, and that's something to watch. On rates is I have the same. Yeah, I have the same view as Clement on rates. Fed funds probably will remain at this level, certainly through the end of the year. Whether they cut it in December or whether they cut in January, it really doesn't matter. And the other thing is everybody's going to look at the dot plots that the Fed puts out, and whether it'll be one cut or two cuts in there. The next move will be to cut, but the thing is, what will force the Fed to cut will be a rise in unemployment. And because my guess is they're going to begin to see the inflation coming from the tariffs over the summer. Now, economists have been saying we should be seeing it now. It hasn't happened yet, but my guess is it's in train and will be there over the summer. When we saw the steel and aluminum tariffs that Trump did, we saw it in washing machines and dryers and what have you in 2018, 2019. Now, this is the deficit as a percent of GDP. And they said OBBBA, that means One Big Beautiful Bill Act. That's what it's officially called. One Big Beautiful Bill Act of 2025. That is the official title of the tax bill moving through Congress. Unbelievable. Unbelievable. They didn't call it the Tax and Jobs Act of 2017, which sort of made sense, what they did. But that's One Big Beautiful Bill. And what has here, this doesn't have the tariffs in here. Under current law, deficit would, as a per share GNP, would drop to a little over 5% and rise to 6%. The OBBBA as written, deficit will rise to 7%. If it stays permanent, if all the tax cuts in there stays permanent, it rises to 8%. So clearly, these numbers are clearly unsustainable at a time when we're at roughly full employment. If we had high unemployment right now, you could make a case for having a high deficit. There's no basis for having a high deficit now. Now, the tariffs will offset a lot of this. And the press isn't picking up on that. The tariffs will offset a lot of this. So we may end up with what current law looks like. Still unsustainable. It'll still be 6%. It'll still be 6% of GDP. But so basically, we're talking about a big tax. The thing is, everybody says be very, very stimulative. We're going to have a big tax cut coming to the economy. It's going to be stimulative, but there's a big tax increase that's taking effect right now that's going to offset, in my opinion, most of the stimulus. All right. The only thing is market is very complacent. Markets are not worried at all. This is the high yield spread, which is the high yield bonds versus 10-year treasuries. We had the spike here with the tariffs in April up to 4%. They've come down. So the market is extraordinarily complacent about the economy, about inflation, and the market is looking at the world as being in a pretty good place. The S&P 500 has rebounded back to 6,000. It dropped 20% in April, very, very fast decline, and made it back just as quickly. And the thing is the problem with the market right now is the market's trading at a very high multiple, 23 times. The earnings yield on the stock market is 4.32%, which is basically the inverse of the PE. The 10-year treasury, when I did this, was 451. 10-year treasury is now 435, some plus or minus this morning. It means there's no equity risk premium in the stock market. Treasury yields are higher than the earnings yield on stocks. So that makes it hard to make a case for much higher stock prices. In terms of the forward PE ratio, this is the history. So this is in 2000, it got up to 24. In May, here it got up to 21. In 2022, here it's 21, 22. So compared to history, we're at extraordinarily high levels. And this is where stocks have historically peaked out. This here is the Case-Shiller price earnings ratio, which is a cyclically adjusted price earnings ratio. It's a Shiller ratio, not Case-Shiller. And it's 37 times right now. And the only other time it was this high was a little bit in 2022 and then in 2000. So at these levels, it's very hard to make a case that stocks will maintain their long-term average group gains of 8 to 10%. It's very hard to make that case. And then, so to conclude, I think we're in a new world order. We're entering an era of higher inflation and slower growth. Tariffs aren't going away. So back to the future, back to the 19th century. And we're going to be arguing about tariffs for the next 100 years, in my opinion, whether too high or too low. Tariffs also are, very important to know, a pathway to governmental corruption, because everybody's going to go to Washington to ask for exemptions. That's what happened in the 19th century. That's what's going to happen now. It's a pathway to all kinds of corruption. The federal deficits are unsustainable. Interest rates will be high. And in my opinion, it's very hard to make a bull case for the stock market. Thank you.
Well, good morning. How's everyone feeling? I know we are potentially giving substance to the notion of our practice of the dismal science. As a Canadian, I'm happy to report we are also not yet destroyed as I stand here. My job this morning is to give you a specific sense of how these forecasts relate to the funding challenges you have as people in the commercial real estate space. I should note as a guest here, and I'm thankful to my hosts for the opportunity to speak with you, I was not involved in crafting the forecast, though I entirely agree with it. I think it's a very sensible reading of where we are and where we are likely to go in the near future. As a child of the 70s, it looks familiar to me. I see stagnating growth and higher inflation. We haven't used the term yet today, stagflation, but it's certainly a stagflation light scenario, one that might not continue for a terribly long time, but is likely to be the leitmotif of the year ahead. Data from the Mortgage Bankers Association imply that 1 in 5 of you are going to be rolling over a substantial portion of your financing this year. So figuring out what this forecast means for the rates at which you'll be able to do that is particularly important right now. It's always an issue in commercial real estate, but it is an issue for more than it would be on average amongst you. I am going to deliver a slightly tougher message on rates in that markets are currently pricing 2 cuts from the Fed in the second half of this year in September and December of a 1/4 point each, and then another 2 cuts in the first half of 2026. So a little accelerated compared with the forecast here at Anderson. I don't think any of those 4 cuts are coming forward unless, as David noted, we see a substantial weakening in labor markets, which isn't going to be helpful for commercial real estate either. And so what I want to do now in just a few minutes is talk you through the framework that we as economists use to provide a view like that. So you can keep updating your view and your financing decisions as you go forward with the information and data that we receive over the next few months. I'm mindful that this is a bit of a high wire act because at 11 o'clock, we're going to get the FOMC decision with updated forecasts. And it is entirely possible that we'll have a very awkward coffee break where I've been contradicted entirely. But as Harry Truman once said, he was sick of two-handed economists coming and saying, on the one hand this, on the other hand that. I'm going to give you a very one-handed notion of where I see things going. But to give you a bit of a picture of that MBA data, in 2025, there's nearly $1 trillion in commercial real estate financing that is set to roll over. The 3 bars for each year simply show data from their year-end 2022, 2023, and 2024 survey. And so what you can see is because of high rates in 2024, those rollovers have gotten pushed into 2025 and into the future. So about $1 trillion out of $4.8 trillion in outstanding financing in commercial real estate is set to be rolled over in the course of this year. Now, when we look at how people, businesses, and the economy more generally think about financing costs, economists tend to refer back to what is known as the Fisher equation, named after the 20th century economist Irving Fisher, where we take the nominal interest rate I and adjust it by expectations where inflation is going in the future. We do that because if inflation in the future is going to be high, you're going to have an easier time paying off a loan because you'll have been able to charge higher rents, or if you're a worker, you're likely to get higher wages. If inflation is low, it's going to be tougher to pay off those debts, which is why we often talk about governments sometimes inflating away their debt burdens. We think that real interest rate, rather than the headline nominal rate that you see from the Fed or when you go to your lender, is what really drives a decision to borrow or not. And central banks have 4 sets of tools to affect those rates. They have the Fed funds rate, the first bullet here that gets announced in just a few minutes, where we think there'll be a hold. They can also engage in quantitative easing, going out and buying securities in the markets to push down their yields, or is happening now, quantitative tightening, where they're just simply letting those roll off their balance sheet. Or they can change the amount of deposits that banks have to hold in reserve. And if they increase that ratio, that amount, it makes it tougher to get a loan, and that pushes up interest rates. All of those change the nominal rates that you face. What I'm going to talk about today is why there's a 4th tool the Fed is using, and Jerome Powell is using it very importantly right now, and we're likely to see a case of that today, where we're not just going to get a hold in the Fed funds rate, and markets are pretty much 98, 99% convinced that's what we're going to see, but we're likely, in my view, to get a hawkish hold. And you'll hear this distinction between hawks and doves in central banking. A hawk being one that's more concerned about inflation, less likely to cut. A dove being one that is more concerned about the unemployment side of the Fed's mandate and more likely to reduce interest rates. That distinction is important. It is going to be important through the rest of this year, because if we don't see, and I don't think we will see any cuts, the language around those cuts is going to matter a lot. And if you see a hawkish cut right now, or a hawkish hold, let me say, that is an attempt to get your inflation expectations down, get everyone's inflation expectations down, and push up that real rate. Because inflation is still higher than the 2% target. What Powell is trying to do there is convince you it is not yet a good time to take on extra borrowing. And by changing that real interest rate, a central bank now has that 4th tool around communications to affect how much borrowing happens and what impact that has on inflation. Now, right now, we've got a debate between what I call, this is my term, you won't see in the Wall Street Journal, the marginalists who look at the most recent data coming out, and I'll call them the levelists, who are concerned about what level real rates are at. Now, if you look at marginal data that's just come out, Clement mentioned in the first quarter, we saw a negative growth rate, and there are good reasons to think things aren't quite as bad as that, but we've certainly seen cooling from around 3% growth last year. When we look at unemployment, it's coming up. So both of these things augur for a cut, but we still have inflation above the 2% target at 2.4% in May, and in our forecast likely to go further up. So some mixed evidence on whether we really need a cut right now. The levelists look at what is called the real natural or neutral rate of interest. We use models, and the Fed runs the most prominent one, trying to determine what's the level of the real interest rate that is neither encouraging you to borrow more or making it harder to do so. It will just kind of be a Goldilocks level, keeping us just right. Economy that's humming along with close to full employment. If that real interest rate is lower than R star, it says, let's cut rates, and we should lower that nominal interest rate I, or if it's higher than R star, then we should rate, if it's higher than R star, then we should raise rates. Because, I've just said that backwards. If R is lower than R star, we should cut our nominal, we should raise our nominal interest rates. And if R is higher than R star, we need to cut our nominal interest rates to make conditions looser. Right now, inflation expectations are around 3%, and you can look at a range of different inflation expectations. Some are a bit lower than that, depending on who you ask. But at around 3%, our current Fed funds rate is already mildly stimulative. It doesn't augur for another cut. And let's just do the math here. We can find out what our real interest rate right now is based on the Fed funds rate and our 2-year inflation expectations. So the Fed funds rate is about 4.33%, the average of 4.25 and 4.5, the range it sets for us. 2-year inflation expectations from the New York Fed are 3.1, and the net of those is a real rate that's 1.23. Our estimate from the Fed of that neutral rate, that Goldilocks real rate, is 1.37. So that says right now, we don't necessarily need another cut. If anything, we're on the mildly stimulative or accommodative side. We're on the side that says we're providing enough support to the economy from the Fed. And you'll see that our star estimate has been trending downward, and that's a reflection of global savings gluts, slower productivity growth, and aging populations. It means we can't sustain rates that were quite as high as we could a couple decades ago and still grow. So in this context, and was mentioned earlier, the comments from President Trump aren't really helping. Calling Jay Powell a numbskull, threatening to fire him, saying they're going to have to force something, some kind of cut, paradoxically makes it less likely rather than more likely we're going to see a reduction in policy rates. And that's because all of those comments force up expected inflation, which then pushes down the real interest rate, your real cost of borrowing, which Jay Powell doesn't want to do when inflation is already and still and likely to go higher above 2%. In fact, that increase in inflation expectations and reduction in real rates, making the cost of capital cheaper, could boost borrowing and spending, increase real inflation pressures further, limit those reductions in nominal rates that I mentioned. And if we get a dovish Fed appointment coming next year, that just makes the situation worse. That makes the space for cuts even tougher. Tariffs and fiscal deficits compound this by pushing inflation expectations up and pushing the real rate down. And they together leave very little space for a nominal interest rate cut from the Fed. And it means the funding environment for commercial real estate is going to be at least as tough or tougher than it is now. We're not likely to get cuts from the Fed this year or early next year. And we're also not likely to see the middle and longer end of the yield curve come down. Because even if we did see those Fed funds cuts, they would come with the expectation of higher inflation in the future, and bond yields would almost certainly rise along with them. So the main message here is that Chair Powell is likely to keep saying today he's not in a hurry to cut rates because he wants to get your inflation expectations down. And so none of the current discord is helping financing conditions. And if anything, it's not likely to get better in the near term. So if you can lock in a rate today, my advice would be, while it's not investment advice, make some effort to do so. Thank you very much.
Thank you, Brett. Excuse me. So 2 things. One is we like to take a couple of questions from our in-person audience. We don't have a lot of time because we have so much content today. And in that regard, we're going to power on through and not have a break. So if you need to stretch your legs or otherwise, the facilities, you go out the door here, turn to the left, you'll find the facilities, but do come back. And do we have any questions from the audience? Yes, I think there's a microphone here.
Just really quickly, you're Clement and David both mentioning quite a bit about the revenue generation, the federal revenue generation from tariffs. I'm curious if, though, this is going to cause a situation where through the more corrupt regimes, chicanery, and kind of sketchy situations, there are going to be a lot of workarounds that really clamp down that revenue. The Trump administration has not been keen to fund the IRS. They've enforced immigration because they care about it, but they haven't seemed to enforce tax policy too strongly. I'm wondering if this is a lot of a risk toward that revenue stream in your guys' view.
it's going to take a while to do the tariff workaround. So initially you're going to get a lot, and then gradually it'll start to be eroded. And that's what in fact happened with the McKinley tariffs. It took a while. It took several years, and it got more and more corrupt. And that was one of the things that forced the change from tariffs to income taxes. It isn't going to happen. It isn't going to happen immediately.
Yeah, I have nothing much more to add on that, other than the fact that, that like David said, you know, they really need these revenues to offset the tax cuts from the income tax cuts. So while there may be some workarounds, I mean, still expect a substantial increase in tariff revenues.
I would just add, there's real doubt that they're going to get the revenues on the levels they expect, because if the tariffs work, trade volumes go down, and you don't get to collect as much tariff revenue as you would have otherwise done, which means greater pressure for the federal government to fund itself with bigger deficits, and greater upward pressure on rates in the medium and longer end of the curve.
Okay, next question.
For those of us in the commercial lending space, we watch the 10-year treasury on a daily basis, multiple times in the day. I'm wondering what your thoughts are about, and I did remember seeing a decline going into, I think, end of 2026, maybe 2027 in the 10-year treasury. But I wonder if you could comment on that and what you're seeing going forward.
Yeah, so the main thing for long-term interest rates now is that we're seeing a rise across the world, not just in the US, but for US specifically, there are two additional factors pushing it up, which is an increase in the term premium, which is this higher US debt to GDP, which is meaning that there's just a lot more US debt out there that has to be held by someone. And so that's keeping the prices that people want to use to hold that up. And that makes the prices lower because there's so much of the supply, which has the yields high, right? On top of that, we have a higher risk premium for investing in the US, right? This is a less safe place to put your money, and especially with a tax bill that has a Section 899 where foreigners can be taxed on their income streams from the US investments almost, you know, arbitrarily. That's also not a good sign. So these are a lot of the factors right now that are going to keep interest rates higher for longer, you know, or in the long term going forward.
The Treasury will be exempt from the 899. The 10-year Treasury, but commercial mortgage interest would not be, CMBS would not be exempt from that.
And just one point to underscore from Clement's presentation, for the 10-year yield to come down in that forecast, you do have to see unemployment come up. The only way that 10-year yield really comes down durably is if the economy weakens substantially, such that markets start anticipating those rate cuts coming through.
Okay, so is that one more question? Okay, last question.
First off, Jerry, I just want to thank you for your great work as director of the. You've done a fantastic job, and I've learned so much every time I've come. Just a quick question. I'm with Assemblymember Rick Chavez-Zibur. We represent Westwood and UCLA in the State Assembly. We've had a lot of constituents who have moved into our district after the fires, which are just outside, and we get a lot of questions about, when might be a good time to move. Are you guys seeing any movement in prices of apartment rentals, given the what we've discussed related to real estate?
We certainly did after the January fires in Los Angeles County and in Orange County. The history of wildfires, let's take, for example, in Sonoma County, with the Tubbs fire, is that you see that initially, and then people move further away, or they rebuild and come back in. So it's kind of temporary, but temporary means 4 years. But there's been more pressure on the housing stock, particularly in LA and Orange County. Yes.
Thank you so much.
Thank you. So for the last 18 years, the UCLA Anderson School, the UCLA Anderson Forecast, has partnered with the law firm of Alan Matkins doing a survey of commercial real estate, kind of 4 different spaces in commercial real estate over 8 different markets in the state of California. And it's done twice a year. The last survey was just done in May, so it's fresh. All the analysis hasn't been done, but we get a sneak peek by Spencer Kalick. Spencer is a partner with Alan Matkins. You have his bio, and I urge you to read it, but we kind of want to move to the content. But he has deep experience in very complex real estate transactions across kind of all commercial real estate spaces. And so let me turn it over to Spencer.
All right, good morning. Can you guys hear me okay? Check, check. We're good? All right. Good morning, everyone. As Jerry introduced myself, Spencer Kalick. I'm a partner at Alan Matkins. I'm also the operating partner of our Century City office. I want to be very clear that I am not an economist. I didn't get to go to UCLA. I went to Northwestern. I got a C in economics. So you're going to see some surveys up here. You see some slides. Don't ask me what they say. No, I'm joking. I know enough to be dangerous. But what I really wanted to do was to talk about not just what the UCLA Alan Matkins survey forecast looks at and what the results are, but also give some real on the ground information about what we're seeing. This morning has been, for those of you sitting and listening, maybe a little depressing, a little hard to hear. We're going to try and add a little levity. I will admit that this morning I was going through my presentation. My wife's out of town for work, going through the presentation with my 2-year-old and my 6-year-old. And at the end, they said, "Dad, this is really boring." I said, "So what am I supposed to talk about?" And so my daughter said, "Well, how about princesses?" Which I was like, "Oh, that'd be interesting." And I said to my 2-year-old, "Okay, what do you want me to talk about?" And he said, "Lightning McQueen." So I've now talked about princesses and Lightning McQueen. I've checked the box for my 2-year-old and 6-year-old. I got, I think, one of the first or second laughs of the morning, so I'll take it. And let's get into what we're seeing. So multifamily. Multifamily is kind of the sexiest thing, if you will, in commercial real estate at the moment. Everyone wants to talk about multifamily. We're seeing the rental rates are, let me back up one second. If for those of you who aren't familiar with the survey, this is a survey of folks who are in the real estate community, what they're seeing on the ground, what is the sentiment. We've been doing this, like Jerry said, for many, many years, across multiple sectors, across multiple markets in California. And so this gives you kind of what are people on the ground seeing. What they're seeing in the multifamily space is that things are strong. So in LA, Orange County, San Diego, Inland Empire are all expected to see below expected growth, while Inland Empire rates even falling below inflation. But in San Francisco, Silicon Valley, those stand out as stronger than expected rental growth, while East Bay and Sacramento are anticipated to grow in line with December expectations. Vacancy rates are generally stable or declining. Most regions are expected to remain steady in terms of vacancy levels. And in Orange County, San Diego, San Francisco, Silicon Valley are forecasts to see decreases in vacancy. So what are we seeing on the ground? And what I can tell you is everyone wants to talk about multifamily. It's, like I said, the sexiest part of what I do every day. It's what I get the most phone calls about. Everyone is either buying multifamily assets right now or entitling multifamily assets right now. Notice I said entitling, one, because I'm a land use and real estate attorney, but two, because most people are entitling things, not necessarily building a lot at the moment. And on my desk alone, I've got about probably 20,000 multifamily units under various states of entitlement across California. So we are seeing a lot of action in multifamily. Hopefully, as we were talking about earlier, some of the capital markets will ease up a little bit. Some of the construction prices will come down, and it'll make sense to start building multifamily. Industrial. So the industrial sector in our surveys found is experiencing generally positive momentum across California. Rental rates are expected to grow moderately in nearly all major markets. Vacancy rates are projected to remain stable or decline, particularly in the East Bay and Silicon Valley, signaling a bit of tightening in our industrial markets. But sentiments are positive and improving pretty much everywhere when you compare it to our last survey back in December. As Jerry said, we do this twice a year. So things are getting better, if you will. At least a little bit of good news. But demand is still growing faster than supply kind of across the state. So industrial has remained strong. We did something, we took a chance and we started a podcast related to the UCLA Alan Matkins. There's a forecast. For those of you who haven't checked it out, you can check it out. You can go online, go on Apple or Spotify and check it out. We have one of our first interviews with Scott Sawanek from Stream Real Estate. He was talking about kind of his positive outlook on the industrial sector. So I encourage you to kind of hear boots on the ground, not from a boring attorney, but actually people who are in the industrial space every day, what they are seeing and experiencing kind of moving forward. Office space. Everyone loves office space right now, right? Who's in the office every day? I am. I see like one hand in the back. Thank you for being honest. Okay, I'm in the office like 4.5 days a week. Fine. So our survey has found that in San Francisco, East Bay, Silicon Valley, Sacramento, rental rates are expected to grow modestly or remain flat. Vacancy rates are expected to decline slightly or hold steady. Percentage of developers developing new office space is higher in both Northern California and Southern California relative to our 2024 survey. What's interesting about this, I did a kind of a small group for a ULI session the other day in Orange County, and they say, wait, what are you talking about? Like office space is positive? I don't understand. Because they're like, we're not doing an office space. And I'll tell you, as a land use attorney, I usually get some of the first phone calls of, hey, I want to buy an office or I want to create a new office space. What do you think? And we started getting the phone calls again about building new office. Now, frankly, it's a lot of end user requests, but it is starting. Like I didn't get a phone call about a new office project for probably 4 years, and I've started in the last couple months. What I can also say is the percentage of developers planning new office space in Northern California has increased to 17%, which is up from 5% a year ago this time. So again, looking for some green shoots, if you will. And it's not all bad news. So we recently bought an office building for one of our clients, Pendulum Property Partners in Glendale. I can tell you the office leasing velocity has picked up there. If you're looking for office space in Glendale, Dan Wagner might be in the room to get you a good deal. Dan also did a UCLA Anderson Alan Matkins podcast with us, so you can learn more about that by checking out his podcast. And then retail. In my house, retail is very strong. Number of Amazon boxes or bags that I see walking into my door every day telling me the sentiment is very strong. But what did the survey find? Sentiments are optimistic everywhere, except surprisingly Sacramento, LA, and the Inland Empire. Again, I don't know if my family was included in that. Sentiment has improved only in San Francisco. And for those of you who travel throughout the state, I can tell you, I was up in San Francisco about a month ago, and it's just, there's a very different vibe, a very different feeling. Union Square may be a little bit rough at the moment, a lot of vacancy, but as you're walking throughout town, things are absolutely, and the retail spaces are starting to re-tenant, not with your traditional, stores, but kind of new things you haven't seen before. And this kind of tracks with what we're finding in the survey. Vacancy rates are anticipated to remain stable across all regions. Rental rates are expected to grow across all of our surveyed markets. In LA, Orange County, San Diego, Inland Empire, East Bay, growth is projected to be a little slower than previously anticipated. And again, in contrast, kind of the Bay Area, San Francisco, Silicon Valley are expected to see stronger rental growth. I got to talk about a podcast again because I find it super interesting. We interviewed Joey Miller, for those of you who don't know, who was the Runyon Group. They have the platform in Culver City and the new post up in Montecito. And what he has found is the way to really draw retail is to have a really interesting experiential place where, similar to my wife who works remotely, she can go meet a couple other folks who are working remotely, sit at a coffee shop, and then have lunch, and then maybe walk to a new store and buy a shirt or buy something and really make it an experience as opposed to kind of just a random store or quick buy. So that is our very quick overview of the survey. I want to keep you all on track. I don't know if I'm supposed to take questions or what have you. What I would say is we really appreciate our partnership with UCLA Anderson Forecast. I am very sad that Jerry is going to be moving to a different role in the forecast, but super appreciative, Jerry, of all of your time in partnership with my firm, Alan Matkins and Anderson. I hope that for those of you who I haven't had a chance to meet, you'll come say hi or, use my QR code because Andre was kind enough to put one on my presentation. Send me an email, send me a note, friend me on Instagram or LinkedIn. We'd love to chat and hope that you all will read the survey once it's out shortly. I know that our team, Sayantani and Seth and Leah have been working hard to put it all together and excited to be with you all today. So thank you so much.
Thank you, Spencer. And so the bottom line there is the full analysis of the survey is going to be out in a couple of weeks, and it will be on the Alan Matkins website. You can access it there. It'll be on our website. You can access it there. By all means, go and read that. And I think we've actually done well on time, and we need to sort of get set up. We've got a great keynote and a panel. So let's take an unexpected 10-minute break so you can stretch your legs, but let's really try and keep it to just 10 minutes. So it's now 10:46. We'll start promptly again in 10 minutes. Thank you. Okay, is that on? Yes. So our 10-minute break that was really 15 is now over. We're ready to start again. So if I can ask you all to take your seats, that would be great. You have to wait. Okay, so we are very privileged to have with us today Angela Aman. Angela is Chief Executive Officer and a member of the Board of Directors of Kilroy Realty Company and has been in that role since 2024. And prior to that, she was President, Chief Financial Officer and Treasurer at Brixmor Property Group from September 23 to January 2024. And previously Executive Vice President, Chief Financial Officer, and Treasurer from May of 2016. Prior to Brixmor, she was CFO at Starwood Realty Properties, and kind of the list goes on and on of her deep knowledge and experience in commercial real estate. She's a member of the Board of Trustees of Equity Residential, where she chairs the Audit Committee, and also a member, and thank you for this, UCLA Anderson School of Management's Board of Advisors, and NAREIT Advisory Board of Governors, where she chairs the Audit and Investment Committee. And additionally, she serves on the Executive Committee of the Zell-Lurie Real Estate Center at the Wharton School at the University of Pennsylvania. And Angela is a graduate of the Wharton School. And so welcome to UCLA, and thank you for being here.
You won't hold that against me.
And I seem to have lost all my questions, so I'm going to wing it. No, I haven't. Yay.
Excellent.
So I think the first thing that's on people's minds when it comes to commercial real estate is what at least was, maybe still is, the disaster of office space and commercial real estate in the city of San Francisco. And you all have a number of projects there on Mission Street, on 3rd Street, and so on. And so what are you seeing in San Francisco? Spencer just told us that he was there and saw a very different San Francisco a month ago.
Yeah. San Francisco, or the Bay Area in total, is actually Kilroy's largest market. So we own about 17 million square feet of office and life science product and a couple mixed use projects really up and down the West Coast, and then a small but growing portfolio in Austin, Texas. The company entered the San Francisco Bay Area following the financial crisis, really right on the heels of the financial crisis, and used that as a really good opportunity to snap up some very valuable real estate in San Francisco and in the city in particular, at a time when values were pretty depressed. So that became, over time, again, the company's largest market. We've got about 50% of our square footage, about 50% of our NOI in the Bay Area in total. So we're very exposed, I think, to the disruption that San Francisco's seen, over the last 5 years or so, through and kind of coming out of the pandemic. What's been really interesting, I think, in the city, even just since I started at the beginning of 2024 and the changes we've seen, I think certainly the change over the last 2 or 3 months has been very, very noticeable. The change since the time of the election has been noticeable to everyone. But I would say, I've been up there probably at least once a month since probably December of 2023. And every single time I've been up there, the city feels incrementally better and like it's headed in the right direction. The election this year was really important for a few reasons. Number one, San Francisco's had this grassroots effort that's really shifted the policy perspective in San Francisco, going back really to the kind of the depths of the pandemic. You had a real grassroots effort, community driven, to do things like recall the school board, to recall the DA. Those things were very effective and sort of started putting San Francisco on the right track. But it wasn't until the election in November of this year where we got a more moderate mayor that was really focused on a pro-growth agenda for the city of San Francisco, but as importantly, a moderate majority on the Board of Supervisors. And San Francisco is a city where probably most of you know, the Board of Supervisors has an inordinate amount of control in terms of the direction of the city. So those two things together have been incredibly impactful for sort of a more pro-business and pro-growth mindset and actual activity on the ground to really kind of take hold. So I do think, while there has been over the last several years so much discussion about the doom loop in San Francisco, I feel very convicted at this point that the doom loop has finally broken. And it's broken because of all those regulatory issues I just described, but more fundamentally, from a real estate perspective, you've had two important dynamics at work. Number one, obviously, San Francisco is a market that's very heavily influenced by tech and demand from, in particular, big tech. And what we've seen over the last number of years, sort of leading up to the pandemic, was big tech taking excess space, right? So leasing tons of space and trying to get a hold of or get in front of what they thought were their space requirements, not today, but over the next 5-7 years. And when the pandemic happened and everyone believed, and I know, I'm sure we're going to touch on return to office and those dynamics in a little bit, but everyone believed they didn't need to bring people back into the office. And in fact, some of those big tech CEOs were really out in front at saying, we believe in hybrid work, we believe in remote work, and we're proponents of it. They started shedding that excess space. So instead of them being incremental drivers to demand, particularly in the San Francisco market, though this also applies to our other West Coast markets, you saw them shedding space, putting space back on the sublease market, and at natural lease expiration, giving space back. And so that really has put a dampener on the San Francisco market overall. That's really, I think I can't say definitively that that's all behind us, but I think we're very much in the late stages of that activity. I think we've stabilized most of that space in the market. And while there will still be some that comes back at natural expiration, most of that has been on the sublease market, is known, and is being absorbed in at this point, a pretty rational way. So I think that dynamic kind of we're being at the tail end of it. We're not seeing huge blocks of space come back from big tech has been really important to stabilizing the office market in San Francisco. But the second important fundamental piece from a demand driver perspective has been what's happening, particularly in the city of San Francisco, from an AI perspective. And I think certainly in talking to our investors, and Kilroy is a publicly traded REIT, and we're talking to our investors frequently, there's been a real willingness or a desire to sort of ignore AI as a major demand driver in the market, and focus on the fact that a lot of the space absorption you've seen from AI companies has come from a few large players like OpenAI and Anthropic and Hive to different degrees. But what we're seeing in our portfolio, and what I think has real legs and people don't yet quite understand on a more fundamental level, is the degree to which the early stage AI companies that are really use cases that are being driven off of the large language model programs from OpenAI and Anthropic and others are taking significant amounts of space. And all of that activity, unlike a lot of big tech, which is sort of more spread out, some in the city, but really, down the peninsula through Silicon Valley, what's happening with AI is very much happening in the city of San Francisco. And the nucleus of that is in Mission Bay, where OpenAI is located. But that is continuing to grow and change over time, in part because Mission Bay is pretty full from an occupancy perspective, and in part because you've now got, again, that doom loop being broken in the city of San Francisco, and across the city, it feels safer, it feels cleaner, and we're seeing, and this was brought up by one of the previous speakers, retail amenitization coming back. right? It's now that you've got employers in this market bringing people back in, you've got new companies and new business formation and AI that are bringing people into the office, and AI companies in San Francisco are in the office at least 4 days a week on average. So you've got people in the office, you've got coffee shops reopening, you've got lunch places reopening. These sound like small things, but it is really hard to bring people back to the office when they feel like they're working in a ghost town. So all of these things I think have been really important to getting San Francisco on the right track and the kind of activity we're seeing in that market now.
Yeah, so that sounds very optimistic for the city of San Francisco. You know, but since the pandemic, asset values have declined and in some cases, at least the ones that have been kind of written up, declined dramatically. How has that affected what's happening in, you know, in the office market and in the retail market, particularly in the downtown and the financial district?
Yeah, I can feel better about sort of the demand picture and where we're at and stability in terms of space being given back to the market. But I don't mean for any of that to obfuscate the fact that we are very much in the midst in San Francisco, but across all the major markets, in the middle of a real flight to quality dynamic from office users in every single market we operate in and every single major office market across the country. It's not dissimilar, I would argue, from what you saw in other asset classes over the last 10 to 15 years, including in the regional mall business, where that flight to quality, you've just got a real widening out of what it means to be a Class A asset. And instead of there being A's and B's and C's and D's, now it's A's and everything else. And so that dynamic is very pronounced. And to your point, most of the trades you've seen in the city of San Francisco have been very low basis trades. And they're assets that people are buying, not, I would argue, most of what we've seen trade have not been IRR driven purchases. We've seen most of the buyer universe for those assets that are trading at $200 to $250 a square foot. And this is changing a little bit, and I can touch on that, but most of those trades have been done by kind of high net worth or family office money that are just making a bet on the city of San Francisco and that it will eventually get okay. And they're okay holding that. It's hard for a company like ours to make that bet and really be thinking about it from an IRR perspective. And it's difficult right now to underwrite how much downtime you're going to have to lease up a property like that and how much capital, importantly, it's going to take to get to stabilization on some of those assets. But the buyers for those assets are less concerned about the interim period where there's limited cash flow. So there have been some of those trades. It's not really impacting yet the competitive dynamic in the city at all, because to my point, many of those buyers are sort of, they're not really trying to lease space or compete against the higher quality buildings in the city. Some of them will be converted to residential or will eventually be repurposed to other uses. So I do think you're seeing it in San Francisco. You will continue to see it across most major markets, a contraction in the stock. And some of the vacancy, particularly in these very high vacancy markets, it's just gonna come out of the denominator. And so I think we're seeing some of that as well. But there's no question, tenant needs have changed. What tenants are looking for when they think about buildings has changed. And there's a real preference for higher quality assets. You've seen it just in net effective rent numbers in the city of San Francisco, right? Since, I guess, fourth quarter of 2019 through this most recent quarter, I think you've seen net effective rents in the city for B and C office assets fall by something like 45%, while Class A office rents, net effective rents are down probably about 10 to 12%. But importantly, Class A rents bottomed in the second quarter of 2024 and actually grown 16% since then. So you have seen, again, that just real differentiation between what's happening to office assets more broadly, what's happening to lower quality assets, and the difference between a B and a C asset being pretty indistinguishable at this point, right? It's A assets and it's everything else. And that dynamic has certainly taken hold, and I don't see that changing.
Yeah, so let's explore that a little more. I remember more years ago than I like to think about, my office was in one of your buildings, the Aero building at the Long Beach Airport. Very much a traditional office space. And it is one of your older properties. Are you finding that you need to modify and upgrade and really do a lot of changes to your older properties so that they are that Class A, that they are attractive to the modern lessee?
Yes, in some cases. Kilroy has a sort of the legacy of this company, the ethos of this company has been really as a developer. So much of the portfolio we own today was developed by Kilroy and was really developed, over the last 10 years or so. We have, I think, the most modern portfolio in the publicly traded REIT office universe. And I think it really just speaks to us sort of fitting that niche in terms of what modern amenities that tenants are really looking for. A property like Arrow, which is a large asset we own in Long Beach and our only asset in Long Beach, but it's really a campus that has 5 or 6 buildings on it. The company had done before I started, and probably, I think it was during the pandemic, a large sort of upgrade and amenitization project. It's not just redoing lobbies, although that matters, but really focusing on how to amenitize the campus from a fitness standpoint, from a retail amenity standpoint, and an outdoor amenity standpoint. So that asset clearly is at the top of the market for the submarket it's in. Across the balance of the portfolio, I think the interesting question we have to keep challenging ourselves with is where can we put that capital to work and be pretty convicted we can maintain our position as an A asset, or in some cases move our position from sort of like a high B asset into an A asset. There are, again, like not to go back too many times to the regional mall business, but that was a trade that worked for a long time in the regional mall business, right? You could take a B asset, B mall, a high B mall, and throw a ton of capital at it and almost be guaranteed you can make it an A mall. And at some point around 2015, 2016, the music kind of stopped. And there were a number of assets that it didn't matter how much capital you threw at them. They were a B that was going to a C or a D. And so I'm very conscious of that dynamic, again, that flight to quality dynamic that you've seen happen in other sectors. And there are some assets in the portfolio where that capital probably isn't going to have the return you would hope that it would in a market that had different kind of underlying dynamics. So I think we're being pretty disciplined and rational about where we do that upgrade and that amenitization and the reinvestment in properties, and other properties where we think this probably doesn't fit with a Kilroy portfolio anymore. And it probably makes sense for us to do a little bit more capital recycling than we've done historically.
And you all have a retail portfolio. We heard in the survey that at least developers are optimistic about 3 years from now when it comes to retail. What is happening with retail? What do you see is going on in that market or in the various markets? You spoke about San Francisco. Is it going to be more mixed use or more traditional retail? How do you see that evolving?
Kilroy really only has one real retail asset, and that's a fantastic asset we own, mixed-use asset we own in San Diego called One Paseo, which has a great 100,000 square feet of retail, but it has an office complex associated with it that gets some of the highest rents in Del Mar. And my team will shudder when I say that, the highest rents in Del Mar, and a multifamily project. So we've got apartments and townhomes there as well. Mixed use projects are incredibly hard to do, and they're incredibly hard to get right. And this is one of the few projects I can really point to in the country where I think it's been done right, that the integration of all those different uses really works. None of the uses get in the way of the others, and there is a real synergy to owning all parts of that project and being able to pull so many different levers to maximize value at an asset like that. Because of sort of what we've created there, I think our experience in terms of that being like a microcosm for the retail universe isn't that great. But, as you mentioned in my bio, I spent a lot of my career in retail, and I think particularly in open air retail. And I think what you've seen over the last 5 to 10 years in retail has been some of the dynamics we're seeing now in office, and actually Spencer hit on, which is no new supply. You haven't seen any new supply in retail for a very long time. Most of my career in retail, the investment community hated retail. It was dying. It was never going to work. They hated it originally because it was the super centers, and Walmart was killing every retail center in America. And then we sort of got through that. And then it was the internet was killing every retail center in America. And yet retail centers still exist, particularly open air shopping centers. You have seen some, I worked for somebody was on the board at Brixmor who used to often say, we're not overbuilt, retail's not overbuilt, but under demolished, which is, was true for a very long time, but I think we've gotten more to parity on that point. So you had an extended period, you had pretty good fundamentals, like despite that there's always retailer bankruptcies and there's a lot of creative destruction that happens in the retail business. Pretty good fundamentals in retail, open air retail in particular, over an extended period of time, and no new supply. And you really saw, particularly during the pandemic, that business come back with a vengeance. And when we're talking about neighborhood shopping centers or open air shopping centers, you're usually talking about a grocery anchored shopping center, some mom and pop small shops, and then larger community centers. You've got your TJ Maxx and your Ross and your Burlington and things like that that have really been a huge piece of why the regional mall business has evolved the way it has. So that business is very strong. It's been interesting now from the outside looking in to watch what's happened with some of the tariff news and the degree to which some of those retailers really do rely on overseas production in order to fill the shelves. And certainly I think people have felt a little bit more concerned about that business more recently, but the underlying fundamentals from a demand perspective are really good. The underlying fundamentals from a supply perspective remain very, very good. And I think there's long-term reasons to feel pretty good about that business.
And you talked about sort of your success in One Paseo in San Diego and Del Mar and kind of that part of San Diego County. Is that something that's unique to San Diego? Do you find similar kinds of conditions in other markets, or is San Diego just a better market right now?
San Diego has been interesting because, like, if you look at the Placer AI data or any of the data on physical occupancy, whether it's our card swipes or Castle data or anything else, employees in San Diego have been back in a physical way in the office for a lot longer than almost any other market in the country. And that to me is pretty fascinating when you think about, I think, the quality of life in San Diego, how many, other places and other things there are to do in San Diego. Housing's a little bit easier in San Diego. People aren't living on top of each other in the same way they might be in the city of San Francisco or in New York and some of those other markets. So there is an interesting, it's almost like just a cultural difference in terms of the speed with which people went back to the office in San Diego that certainly was helpful for our portfolio. But it also is that dynamic where a lot of the office you have there is more conducive to that quality of life and work-life balance kind of marriage, right? People want to be at One Paseo, even if they're in the offices and a short walk to the retail, where there are 6 places to get lunch and there are places to do happy hours. And also we've got a great gym and we've got, like all of the things. So I think I think that really speaks to when we say what makes an asset a Class A asset in this kind of environment, in a post-COVID environment. It's all of those things, less so than just being in the tallest, flashiest high rise in the CBD. Like, that definition of Class A has changed a lot. And I think San Diego, the stock in San Diego, does lend itself well to meeting some of those needs that in a post-COVID world kind of do match up with what tenants are really looking for and seeking. But that's been I think for me, trying to get my arms around it as I was transitioning to this role a year ago or a year and a half ago, an interesting dynamic. Like, why is San Diego back so early and why is LA not, right? I mean, the markets aren't that different, but there's a huge difference in the physical occupancy rates across those 2 markets.
And so as we think about, for example, Central Business District in Los Angeles, how different is that? And what do you see happening there?
Yeah, we don't have any exposure in downtown LA.
You're in West LA.
Yeah,
apparently,
we're mostly West LA. We've got 3 assets in 2 mixed use assets and then 1 more traditional office asset in Hollywood. West Side, Santa Monica, we've got a few assets, El Segundo, and then Long Beach, as we talked about. So I'm not sort of the best proxy for all the dynamics that are happening in downtown LA, but certainly what we've seen, as everybody here is probably aware from a market perspective, has just been that kind of continued exodus of folks out of downtown and into central markets like Century City and other places where I think you're getting more of that work-life balance. There's more amenities available to employees in buildings in that area. Accessibility is incredibly important, right? And making sure it's easy to access for the employee base. And I would just say our hope for quite a while, and this is the one place I'll be a bit of a dampener and maybe give my San Francisco comments more credibility. LA has been our slowest market without question. That's been true since I started. It's still true today.
So inclusive of Hollywood, West Hollywood area.
Yep, across all of the different, Long Beach actually within our LA portfolio has been our most active. But our more traditional Los Angeles assets have been very, very slow and have compared from an activity perspective unfavorably with almost any other market we're in. And it's been harder for me to create a real bull case in terms of what gets activity moving again in the city of LA. It's, you know, we've been up against so many, I think, different hurdles over the last few years. You've got that dynamic about people just not coming back to the office in the same way in this market they have in other markets, including now what we're seeing in San Francisco, which had also been a laggard. But again, what's happening from a quality of life perspective in the city, what's happening from an AI perspective, all of that's really creating that sort of momentum you need to drive people back into the office. And you've got new business formation and new job formation happening, which we don't really have to the same degree in LA now. This market has been primarily driven by entertainment and media and those kinds of uses, though it is a pretty diversified economy, and there certainly are other uses that we're hoping to see, you know, pop up and take incremental amount of space. But across the board, it's been pretty quiet.
And we always like to compare California to non-California. And you all are in Austin and you're in Seattle. What are your thoughts about those compared to the California markets?
Yeah, I mean, I'll take them. Every market's got a bit of a different story. And in Seattle, I feel like you've got really two different stories. Bellevue has been as strong as anything we've seen in San Diego. That market's been very competitive. There has been new supply in Bellevue that's delivered over the last few years. Some new supply is also, I think, we're starting to see even new things break ground in Bellevue. And that really is we'd always prefer less, but it's not as much of a concern because we continue to see space absorbed at a pretty quick pace in the Bellevue market. And so really good fundamentals. Anytime we've got vacancy, we've got prospects and tours, and it's been very, very active. We're starting to see some of that spill over into South Lake Union and down through Denny Regrade, but it has been slower, right? We had been to some degree hoping that the dynamic we're expecting in LA is that you continue to see tenants move out of downtown. Century City will be full. We'll see some spillover into West LA. We haven't seen that yet. But we are starting to see some of that dynamic in Bellevue. Companies come to town, really want to grow, and not just want to maybe grow today, but want to know that they can accommodate future growth as well. They've got to look more in South Lake Union and then down through Denny Regrade. The Seattle CBD continues to be pretty quiet, right? So it's not that different. People are looking for office environments that they can provide more amenitization and more opportunities for outdoor amenities, outdoor facilities, things like that. So that also naturally leads people more to South Lake Union, more to Bellevue. But overall, a very strong market. And then Austin, we've got one building in Austin. The company entered Austin in 2021 or 2022 and bought a very high quality office tower in the CBD, just called Indeed Tower. Indeed takes about half of the building, and the remaining vacancy in the building was part of the investment thesis for this. The whole idea of expanding into Austin was really to tap into what was viewed at the time a following of our existing tenant base and our existing tenant relationships with tech companies and other companies like that were talking about major moves or moving significant amounts of headcount to a market like Austin. It just didn't materialize in the same way I think was expected. So the remaining lease up at Indeed, instead of being bigger, chunkier leases that have gotten executed with some of those same players, we expected to kind of migrate more towards Austin. It's been kind of slower, but consistent, steady progress on the lease up side, more professional service kind of uses, more law firms, engineering firms, accounting firms, things like that, and a much more granular lease up story there. But we continue to see good demand. Austin's a market that's had a ton of supply. I mean, that's really the issue in Austin right now, is just a ton of new supply hitting the market recently or is going to hit the market over the next few years. And my view is that that's going to create some real opportunities for platforms like Kilroy. You're going to have developers that are delivering basically vacant buildings into a challenging and very competitive environment and have in place construction loans that they need to refi. And I think there'll be opportunities for us to further expand our portfolio in the market as that plays out over the next several years.
Oh, that's interesting. Not what I expected to hear about Austin. We're just about out of time, but so we have a lot of MBA students that classes out for the summer, but they're online virtually because we have many MBA students who are interested in real estate. And what can you tell them about a career in real estate, particularly starting today?
Yeah. I'd say a few things. This has been like an exceptional place to build a career. Like I can't say enough about this industry and how lucky I feel to have sort of found my way here. I had no connection to it before, I started in college, and it's been a great and wonderful and supportive place to spend really my entire career. It's a very small industry, which can be a very good thing. It can also be a challenging thing. I would just say relationships are incredibly important. And because the industry is so small and everyone knows everyone, be really, really careful, very intentional about how you build those relationships. And so, again, it can really make a big difference positively in your career, but I've also seen it backfire on people in a pretty big way. Do what you say you're going to do, be kind and respectful to people, and people want to support each other and help each other along. So lean into that. I'd also say, and this partially comes from my experience having done a bunch of different sectors and a bunch of different asset classes within real estate, I would really encourage you not to think of yourself as a sector-specific person. It's all just capital allocation, right? Like that's all we do. We're just investors. And the more you think about yourself as an investor or an allocator of capital and not as a retail person or an office person or a life science person, the better off you'll be. I spent 4 years in real estate investment banking, kind of seeing everything. Spent 6 years on the buy side where I picked stocks, focused mostly on retail, but doing a little bit of everything. And then 13 years basically on the company side as CFO of a few different retail platforms. And I'm the CEO of an office and life science company with one tiny retail asset. This is probably not why I was hired. But I think I've seen a lot of people get into that mindset that they need something in a very specific lane. And I just don't think you do. I think the more you can, again, think of yourself as an investor and be as broad-based as possible. This is not a complicated industry. And there's more similarities between asset classes than there are differences. So
Yeah,
I'd say
so
that as well.
flexibility
Flexibility.
is important in your career
Yes.
path as well as many others.
Yes, absolutely.
Thank you so much for joining us here at UCLA today.
Thank you.
Okay, now if I could invite the panel up. So the panel today is being put on by the Ziman Institute for Real Estate here at UCLA. And let me introduce Tim Kawahara. Tim is long time at UCLA, a founding managing director of the UCLA Ziman Institute. And Tim, I'm going to turn it over to you. Thank you.
Am I mic on? There we go. Thank you very much. Or a pleasure to be here. Again, my name is Tim Kawahara, Executive Director of the Ziman Center for Real Estate, and we're here to just do a quick overview of the wildfire recovery efforts here in Los Angeles. How many people are from LA in the audience? Several. How many people are from out of town? How many people have been directly impacted by the fire? Yeah, okay. And how many know somebody that's been impacted? There you go.
There you
Yeah.
go.
So that's the case that we saw right away. Obviously, it's devastating to have two major fires occur in Los Angeles at the same exact time, which pulled on resources and a bunch of different things as well. We as a real estate research center here at Anderson, we just felt compelled to do something. We have a board who's a virtual who's who of real estate leadership in Southern California, and we thought this is largely going to be a real estate issue in terms of the rebuild. We quickly partnered with a group called the Urban Land Institute, of which my two colleagues, I think the bios are in the papers, but I have Darcy Coleman and David Waite, who were very instrumental in helping us put the final project together. Within 3 weeks of the fires, we pulled together about 50 plus CE level folks right here at Anderson to determine what we could do, how we could help. These folks were hand selected based on subject matter expertise. So we had architects, finance folks, we had hazmat, insurance, vertical rebuild, developers. We had the whole range. And so what came out of that was a report that we put out recently called Project Recovery, which maybe you've seen. I think it's 172 pages long or something like that, which we put together in 3 months. So it was just the alacrity was incredible. The speed at which we put it together was incredible. And it resulted in this Project Recovery report. It's really a business strategy roadmap to put things together. There are other groups that are doing things like mental health and public health and soil sampling, although we'll get into a little bit of that. But our focus was really as a business school focused on rebuilding Los Angeles and what that would take, which is obviously going to be a huge lift. This effort's going to be a 3 to 5 to 10 plus year effort to rebuild Los Angeles in terms of both fires. But what came out of it was this report that was organized around a number of different work streams, and we'll go over them briefly. But we had hazardous materials, debris management, removal, disposal, and the process of property safe return, implementing building permit self-certification program, labor and supply chain challenges, strategies to stabilize California's insurance market, rebuild resilient communities, vertical rebuilding, financial strategies for rebuilding infrastructure, homes and communities, rebuilding infrastructure for the Palisades and Eaton. And then we did do a survey, which I can provide a few results as a result of that. But first and foremost, what I think we're just going to do a quick go through. I think what we wanted here was a very informal fireside chat, so just not a huge panel. But we're going to probably zip through these things and then open it up to audience, because I think probably that's the most robust part of the conversations. We've all done dozens and dozens of these talks at this point. So I think the richness comes from answering questions and to be helpful to the audience here, especially those of you that are rebuilding or have been impacted by the fires. So the first work stream was hazardous materials. I can tell you, and I think I'm going to lean on David for a little bit of this too, but there are two phases really. There was the Environmental Protection Agency, which was the first stage. They came in and did all the obvious toxic debris, so the EV batteries and the lead and propane tanks and firearms and that kind of. That's essentially been done. Most of the lots now have been cleared in terms of environmental issues. And then the next stage, which we're in now, which appears to be ahead of schedule, is the Army Corps of Engineers comes in and does the debris removal and cleaning of the lots. And one thing that was, and that process should be done maybe at the end of June, even this month, which is ahead of schedule. I think, I don't know about you, the two of you, but I share some concerns that was done by two federal agencies. So it was done, and they're very used to cleaning up after large scale natural disasters. And when the recovery and execution shifts to more the local government, I think we're going to have to probably help them even more so than the federal government for sure. So, a little bit of controversy, the federal agencies decided not to do soil sampling in the fire zones. They typically had, this is the first time they had not. In lieu, they decided to just scrape 6 inches of soil off the top of the lots rather than the typical 3. And most of the science they relied on, I think, indicated that would be sufficient. Although, unfortunately, we're now seeing that even the scrape lots are being tested, they have elevated levels of lead and heavy metals and that kind of thing. The testing is actually different in both fires as well. Like in Altadena, the vast majority of the homes were built before lead paint, for example, was eliminated. So we're seeing very high levels of heavy metals in the Altadena fire, which we're not seeing as much in the Palisades fire, but there certainly are challenges there. But one of David's colleagues has been working very closely on the environmental remediation. So I don't know, Dave, if you wanted to add anything to that.
Sure, Tim. Just again, context here in terms of the enormity of the challenge. And some of you, I think, know the numbers, but I'll just share them with you just to remind you. 16,000 structures between both the Palisades and Altadena. 23 million square feet of structures were destroyed. It's a daunting challenge in terms of the rebuild effort. We were thrilled with ULI to partner with UCLA and USC, the Law Center. The 3 organizations came together for this work. What I'll say to them about the hazardous waste and the debris removal, we advocated for 3 things. We advocated for uniform standards for debris removal. So there's one standard so that if EPA and the Corps are doing a particular protocol for removal of hazardous waste, if a homeowner decides to hire a private contractor to do that work, they're utilizing the same standard protocol. Because if you have different standards in terms of remediation, you're going to end up with different outcomes. The second thing we advocated for strongly was confirmation sampling. So after US EPA has completed their household hazardous waste removal and the Corps has completed their scrape of the debris and the 6 inches of soil material, that there's an effort to come back after that and confirm that the hazardous materials have been removed. And then thirdly, there's a certificate of compliance that would be issued that would, by the way, stay with the property. And it would be recorded on title so that there would be a record that the site was cleared and confirmed for rebuild. Where I think we're hung up right now on is sort of what is the nature of the confirmation sampling in terms of how deep what constituents need to be looked for, what the forensic methodology is for how that sampling should occur. Because again, it might vary from one consultant to another. And we believe that there needs to be a uniform standard that applies across the board. You know, given the size of the lot, how many samples per lot need to be taken in terms of making that confirmation sampling robust and certain. So we advocated very strongly for that, and it's still in process as we speak in terms of the determination of what will be the end result to confirm that these sites are clean and safe for habitation.
Yeah, and I think one of the game changers from a business standpoint is that financial institutions, including banks and insurance companies, are now considering requiring soil sampling on every single lot before they would issue a mortgage or insurance. And so we need to figure out how to do this soil sampling, if that's the case, cheaply, at scale, because literally every single person will need a soil sample if they want a mortgage. And currently there's not a cheap or quick or standardized way to do that. What we're trying to do, Dave alluded to this earlier, is try to find a standard that will both meet the public health officials and the financial institutions at the same time. It makes no difference to have two sets of certifications in that regard. So another quick area, and I'm going to turn to David again, is the building permitting process. Any of you familiar with getting permits for building anything in Los Angeles knows it's an incredibly daunting task. It could take years, and we're talking about building 16,000 structures. I mean, it's terrible on the best of circumstances in LA. So we've come up with a couple of solutions, self-certification and the use of AI, which is actually being piloted now by both the county and I should mention that when we put this report together, we considered the county and the city of Los Angeles. They were the jurisdictions that were most impacted. It'd essentially be our clients on this and provide them with a roadmap. But David, maybe you could walk us through some of the recommendations on self-certification and expediting the permit process in Los Angeles.
So what we learned, not surprisingly, is when you look at other natural disasters around the country, one of the things that is critically important is the speed with which you recover and the speed with which you re-permit to rebuild. And normally in the city of Los Angeles, I hate to say this, but it takes over a year to permit a home in the city of Los Angeles. That's partly due to the complexity of the city of Los Angeles's multi-departmental. 13 different departments have to sign off on your permits. The county only has 4 different departments, but it still takes as long in the county as well. And what we found is if you shrink those timeframes down to 30 days or less, the outcomes are so much more beneficial for homeowners in terms of returning. We looked at examples throughout the country where that has happened well. The Tubbs Fire in Santa Rosa, there's a community there called Coffee Park. Coffee Park was rebuilt and rehabilitated 80% within 3 years, largely due to the expediting building permits. So what we did is we went around and we looked around the country and we said, what's really working in different parts of the country that we can learn from? And so we went to New York City, we went to Chicago, Phoenix, even the county of San Diego, small communities in Los Angeles like the city of Bellflower that have what are called professional self-certification programs, which allows the architect to certify the plans that they are code compliant and basically shorten the time frame that's required for plan check. Because plan check and plan review is really where you get bogged down in terms of the time to actually get to a point of issuing a building permit. So we looked at those jurisdictions. We did a terrific survey, really good data set of what's working in other jurisdictions. We presented that in the report. I was really happy to see both Mayor Bass and the County Board of Supervisors adopted Executive Order 6 was Mayor Bass's order, and the county issued an order about 4 weeks ago to adopt a pilot program for professional self-certification. The details of those programs are being actually worked out as we speak in terms of how it's going to work. Basically, there's qualifying criteria for certain projects that will be able to qualify for self-certification. There will be certain exemptions. For example, complex foundational elements, certain hillside properties would not qualify. And even the city of Los Angeles has said, we don't want to self-certify pools. Okay, so pools are out. But the point is that we think that self-certification can really shorten the time frame in a way that's meaningful, that will allow the permitting to occur consistent with the governor's executive order right after the fires, in which he suspended the California Environmental Quality Act, and he also suspended the Coastal Act for permitting to get the permits to be issued within 30 days or less. And that was also consistent with Mayor Bass's executive order. So this 30 days is sort of the goal, and the question is, how do we get there? And we believe that the professional self-certification program, coupled with consolidating the departments into a single coordinated review, can get us to this 30-day time horizon. And I'll mention one other thing, Tim, which is it's combined with AI tools. There are a host of new AI tools that are available to really expedite the plan check process, where essentially you put the plan into the model, and the model within a matter of seconds will tell you whether it's compliant or not. It also updates when codes are updated. So you have in real time this AI tool that will enable professionals to confirm that the plans conform to building code and building standards. So that's the goal on self-certification.
And to be clear, at the end, it does need to be inspected ultimately by a
Correct.
city agency. So this is just expediting the front end, but at the end of the day, it will still be signed off in terms of building and safety and all the other codes.
That's right. And we advocated for a dedicated inspection unit, which would use the same AI tool that building and safety is using in the permit process. So they essentially will be on site with a tablet, looking at the plan and making sure that the building has been constructed in conformance with the plans. And the contractor will also have access to that same tool.
Yeah, and the next work stream was labor and supply chain challenges. I'll just go over that extremely briefly. Obviously, the logistics are going to be a huge challenge with, hundreds and thousands of construction workers and trucks going up and down and doing all the utility rebuild and orchestrating all of that, particularly in the Palisades where there's not really great ingress egress is going to be a significant challenge. And then I'll just mention briefly that on the supply chain labor issue, there is obviously the threat of tariffs hanging over us. And so that could obviously have a tremendous impact on our ability to rebuild. For example, 70 to 80% of the lumber in the United States comes from Canada. Most of this rebuild is going to be stick build. It's going to be wood structures. And obviously that would have a significant impact. And then of course, on the labor market side, we're already facing a tight labor market in the construction business. And then if you add to that 41% of our construction workers in California are immigrants. I don't know the legal status of each one, but certainly some will be deported depending on how wide scale the raids are and how long they go. And then of course we have lots of construction workers that are simply not going to show up at job sites because they're going to be scared of being detained or questioned or harassed or whatever, even if they are documented.
Tim, I'll just mention, so the projection is that when this gets ramped up, it's starting, by the way, as we speak, we're starting to see permits and buildings start. But 300 permit applications per month in both the Palisades and Altadena. As many as 1,000 homes in each of those communities being built simultaneously when we ramp up. So sort of what we call full reconstruction. So if you think about 1,000 homes in each of the Palisades and the Altadena communities being constructed simultaneously, the demand on both materials and labor is going to be very significant.
Right. And the next work stream, I'll turn to Darcy. It's strategy to stabilize California's insurance market. Listen, insurance is at the center of all of this. If you can't get insurance either now, unfortunately, a lot of the folks in both fires were either uninsured or underinsured. I think almost all of them were underinsured. So they're going to have a huge gap to cover in terms of what they're going to be reimbursed for and the actual cost of reconstruction. So we need some level of insurance reform. We've already seen some of it. I think State Farm was granted like a 16% across the board, and they've asked for another. I think we're going to have to figure out how to price insurance and allow insurance companies to use climate models in pricing their insurance products. But Darcy, why don't you walk us through
Sure.
the insurance component?
Absolutely. With the insurance component, it's very interesting because what we realized is that insurance touches and feels every component of rebuild, financing, and even on the construction side. One of the biggest issues and the biggest gap was the gap of insurance from underinsured to uninsured, people not even knowing they're underinsured. We recommended an AI model as well for that so that people can take an insurance quote, an insurance policy, drop it in, and ask particular questions and see where they may have a gap. The other gap that actually coincides with the insurance issue is the gap in building code from existing build to new build. And we know based on the fact that the fires started in the wild, but they spread from home to home. And that had a lot to do with some of the building materials and some of the challenges there. We also know that we need to reduce the risk. For the insurance to go down, we have to reduce the risk, and that requires fire hardening, that requires forest management, that requires collaboration with utility companies. Although approximately 10% of fires are caused by utility infrastructure, when you categorize that closer to devastating fires, the percentage that are attributed to the utility companies goes higher. So we have to reduce the risk overall to reduce the cost. There are financial models that we recommended. But the key thing that we found out from a lot of our research and collaboration with other people in the industry is that the insurance model does not factor in when homeowners, business owners are doing fire hardening. So they invest the money to fire harden their homes. They don't get credit for it. They don't get the reduction in cost. So we have to require that. Although our public officials are doing what they need to do to increase the cost and allow insurance companies to increase the rate, they also have to hold their feet to the fire and say, if you're going to increase rates, you have to give people the credit that they need so that they can build faster. Because to have a mortgage, you have to have insurance. So we had several recommendations at that level. And that part of it is, of course, more difficult because it's not as simple as asking the public officials to do what they need to do. The public officials and the insurance providers need to come to the table. The FAIR plan is not solvent, and a lot of people are more dependent on the FAIR plan than they are on private insurers. So this is a very multifaceted challenge, but we did, as you stated earlier, we use the public officials as our client, but now we're really digging in and saying, who's our primary client here, and that is homeowners and builders and business owners. As much as we know that homeowners are displaced, there is a whole community of people displaced, and that includes the building owners, the businesses that need to come back into the market and bring these communities back to being a fully actualized community. And we have to deal with the issue of insurance. If insurance is higher than the cost of your mortgage, how can you be insured?
Yeah, it's going to be a challenge going forward. And unfortunately, we did have a significant number of impacted victims that were on the FAIR plan.
Yeah.
22% of the Palisades residents were on the FAIR plan. The FAIR plan, you should know, it's the insurance of last resort in California. It is capped.
Yeah.
And so a lot of these folks are going to have very significant gaps between their insurance reimbursements and the actual rebuild costs. So insurance reform will be critical. We'll have to watch that very carefully. Both our policymakers and business leaders both.
Tim, if you don't mind, I do want to mention one thing. So one of the recommendations that I'll give you a quick rundown. On our insurance team, we had the prior insurance commissioner who is with UC Berkeley. We also have a university economist at UC Berkeley who lost their home. We also have someone in insurance regulations, and we have a gentleman with a company called Vinbrook Insurance who actually wrote several policies, builder risk policies, to build faster, a Builders Alliance coalition, so that this policy could be approved and allow people to build, allow homeowners to have builder's risk. Those are some of the things that were actually built and implemented along with private certification, professional certification. So what we did is not only recommend things, we actually are putting programs together to really help boots on the ground and continuing to work on that. And we will be updating the project recovery report so that you'll understand in real time what's being done. We don't want this to sit on the shelves. We want to continue to work with the public sector and private sector to make sure that we can help our communities rebuild.
Yeah, next work stream was actually vertical rebuilding. So at least a handful of folks now are, and how many permits have been issued?
A handful.
Handful.
Yeah.
Yeah, it's very, very low.
Small.
But folks are going to switch now to actually rebuilding their homes and their structures, what we're calling the vertical rebuilding after the fires. I won't get into too much here. One thought was that the average home person does not know how to rebuild a home. They're not developers or real estate folks. So could we put together some kind of a nonprofit agency that would basically provide a concierge service for home builders and going through all the process from permitting to finding a GC to a number of different things. The other salient issue recommendation here was put together a builders alliance, and that would be to bring together home builders essentially that can rebuild homes certainly cheaper and faster. So if you think about a KB or a Lennar or a Pulte, because they have one architect and one general contractor, they could essentially rebuild a home for, say, $600 a square foot, maybe versus maybe $1,200 up and upwards if you're doing a fully custom home. So we wanted to provide some optionality for people rebuilding, particularly as these people sit down and realize they're going to have financial gaps and not be able to rebuild. One thing we heard from the Palisades, which I think everybody is, understands, is that they don't want the Palisades to become They want to maintain the character, not have it become a tract home, Orange County type of place. I think what the home builders can do though, if we bring in several of them, you're already talking about each one of them having 6 or 7 or 8 floor models that you can choose from. We're not talking about doing these all in a single block, but maybe you mix them in. Certainly would help with the logistics of rebuilding as well. And they could do different things like set different setbacks and do some things to make them look not like tract homes. David, you want to mention anything about vertical
Yeah.
rebuild?
Yeah, so I think, again, to the point of homeowner optionality, as Darcy mentioned, many homeowners are underinsured. So that means they're going to have to be going out and taking on mortgages, either, getting a HELOC on their existing mortgage to rebuild and then consolidating that into another perm. But the point is they're going to go into more indebtedness to rebuild because there's a lot of homeowners that are underinsured. So the optionality is really important. So, if you're doing a custom rebuild, you're minimally at $1,200 a foot, minimally, and probably even north of that. The idea that you can rebuild at $500 or $600 a foot becomes really important for all communities, the Palisades and Altadena. The only way you get there is by engaging with the publics. The publics know how to do it at scale. They have access to labor and materials that can keep the cost down. So I think that the end result, if you kind of look at what the dream is here, is that the homeowners will go into a home building center, and they'll also have an online portal where the Builders Alliance will have 20 different home builders who are participating, everything from custom to semi-custom to production. And you're going to see pre-approved plans on that site that have already been approved by the city and the county. And the homeowner will be able to pick from those plans and have certainty with respect to time. How long is it going to take to rebuild? And so the idea here is that it's very consumer driven. It's very consumer driven in terms of time and cost. So I think that is the goal of the Alliance. And I think they're starting to make some progress. They've got the nonprofit entity that they're forming as we speak, but I don't think there's going to be any shortage of interest in terms of the home building industry coming in and providing the expertise. But again, it's really about cost and time.
Yeah, we've already, I think in the news, some of you may have seen that there are a number of kit homes that are being offered now in the Altadena fire, which obviously drive down costs as well too. Did you want to add something, Marcy?
No, the only thing that's okay. The only thing I did want to add is that key to that, as you said, is cost. Cost is money and time is money. And what we're finding is the longer it takes to build, the less you'll find people who want to come back and come back to their communities, especially if they have children, especially if they're older. We know that we've all come out of COVID, and we know how difficult it was for a lot of children who couldn't graduate. We have that situation again with this level of devastation. So you've got people with children who are going to be graduating. They want to graduate with their friends, and if their friends aren't moving back and it takes a year, 2 years, it reduces the amount of people who are coming back to that community. So we've got to make sure that we can expedite this as quickly as possible, but also make it efficient and provide the sources that people need to get back to their communities. We are also at the epicenter and at the time of coming back to the wildfire season. It's here. So we're going to be dealing with this again.
So the survey that RCLCO did is fascinating. So homeowners, 78% in both Altadena and the Palisades want to come back, only if they can come back in 3 years.
Right.
As soon as you breach that 3-year mark, you lose 30% per year each year thereafter. So if you think about it, year 4, you're going to lose 30%. Let's assume you get 75% who want to come back in 3 years. You've already lost 25% off the bat. In year 4, you lose another 30%. So now you're down to 50%. In year 5, you lose another 30%. You're down to 25%. In year 6, so you see the decline. You see the decline in terms of the willingness to come back, and hence the time and the cost are critical.
Yeah, a lot of these folks, they've found temporary homes to rent, and they are, some have purchased, but they're going to be in these homes for 3 years minimum. And if you have kids and they're in school and that kind of thing, you may not go back. And unfortunately, we're going to see some of that for sure. Darcy, maybe real quickly on some of the financial strategies for rebuilding.
Some of the financial strategies that we're looking at is some of the incremental tax funding, the CRDs, finding ways to bridge the gap between the ability of people to get a mortgage. There are philanthropic organizations who want to put funds into this as well. And we're trying to figure out how can we use bonds to support this. We want to make sure that people know that we're being holistic and altruistic about this, because it's not going to be as simple as someone getting a mortgage. It's just not going to happen. And it's a very challenging time because with the volatility of the insurance market. I put the number of notes, and we know the high interest rate environment. We know that lending standards are getting tighter even before, from January even to now. The things that are happening with our government on the federal side are making it tougher overall. And we know that the capital markets is very volatile, and things are changing with that, and the collaboration with capital markets and what's happening with insurance and what their requirements are to make sure to reduce the risk. Their requirements are tightening. So we have to look at this and figure out a way that we can bridge the gap and make it not so much easier, but make it make sense for people to come back.
Thank you. And then one of the last work streams was the rebuilding infrastructure. So we have to remember, it's not just rebuilding the structures that burn down, whether they be commercial, residential, or civic infrastructure, but actually the roads and the water systems and utility systems all need to be redone as well. This is a once in a lifetime opportunity, in my opinion, to really harden the infrastructure. And, at minimum, we need to underground the power lines.
Absolutely.
The difficulty with that is expense. It's about $2 to $3 million per mile to underground the lines, which if you add it up just in the Palisades alone, we're talking about $1 billion just for the utility hardening, not to mention all the other ingress, egress, and water systems. I think all the majority of pipes in the Palisades were still clay pipes built back in the 40s and 50s. So that all needs to be looked at. I don't believe there's actually been a damage assessment of the infrastructure yet, neither, Fire? Not yet. So we're still trying to, the scope of work and cost is TBD, unfortunately, on a lot of this stuff too. But David, maybe you can walk us through some of the infrastructure rebuilds and the challenges there.
So what we're looking at is how you finance it, right? As Tim mentioned, the costs are unbelievable. But again, this is an opportunity to make these communities resilient and harden them, which includes undergrounding electrical utilities. If we don't do that, it's a big miss, I think, in our collective opinion. But the cost is substantial. So the question is, how do you fund it? What's the financing mechanism to do that? So what we've looked at, I think, and this was a team that was led by Larry Cosmont, we've looked at a couple of different vehicles. One is a bonding, a TIF mechanism, the Enhanced Improvement Financing Districts. And the second one is what's called a Climate Resiliency District. These are two new tools in the state of California that essentially are tax increment financing. So the idea is, on the reassessment now of the properties at their now burnt out state versus their completed state, that increment can be captured in order to fund infrastructure. And it's everything from, as Tim mentioned, water, sewer, undergrounding utilities, and the like. And the estimate is that could be probably north of $500 million of funds that could be available. It doesn't get us there all the way, but it gets us a long way there. So that's one area that we think is really potent. What it does require, it requires some political will, because those funds that are being collected that are going to be allocated to the increment for the TIF comes out of the general fund, and it's going to go into that financing mechanism for, let's call it a 30-year period, right? So the city has to say, and the county has to say, we're willing to commit those funds that would have otherwise come in through the increment in the value to go to fund the infrastructure. And they can make that decision now, and it can provide resource now. So that's another work stream that we think is really important. And again, it's in process as we speak.
Yeah, I think it's important. We're not just building infrastructure in terms of, homes and, infrastructure and buildings, but we also have to think about rebuilding our civic infrastructure. So we're talking about schools and churches and synagogues and parks. If you don't have all those amenities, you don't have a community. So that sort of civic infrastructure needs to be rebuilt as well. So I'll probably leave it there. That's a very, very quick overview of what's a very complicated, probably 15-year effort here in Los Angeles. It's going to be very daunting. I think that we are prepared to continue to provide guidance to the city and the county as the recovery evolves. And certainly try to keep people in their homes. Unfortunately, we're already seeing hundreds of lots for sale now. People are just realizing they can't rebuild, and they're cutting their losses, and they're leaving a ton of home equity in their homes. And for some communities, that means breaking that, the passing of generational wealth. And so there's a lot of challenges, a lot of social equity challenges. There are a lot of things that we're going to have to look at on a going forward basis. But why don't we open it up to questions to the audience after that extremely brief, complicated overview of what's going to occur here in Los Angeles? So I think we have mics if you want to step up and ask a question. Yeah, Sebastian.
Oh. Where is, oh, it's on
And if anybody, I know this is supposed to wrap at 12, so we won't be offended if anyone needs to take off.
So maybe, Tim, thanks very much to the panel. Let me just introduce myself. I'm Sebastian Edwards, and I have the very difficult task of replacing Jerry as the director of the forecast. And I'm very thankful to Jerry for his work. But let me ask you a question. I don't know if you know, Jerry was affected by the fire, and so was I. Not my
So was our
personal.
last speaker, Angela Aman. was-
Oh, so did I? I didn't know that. We just got our new property tax assessment, and we were very disappointed by the adjustment. So I would like maybe the panel to comment on what do you think, whether it's being done properly and whether homeowners have a recourse after this very minimal reassessment that we are seeing. I haven't talked to other people, but we are certainly very disappointed by the new assessment that we got.
Yeah, it's a huge challenge, and I can say that it's even more so in the Eaton fire. There's a rule that if you build what we call like for like, if you build essentially the same home plus you could add 10%, you still are streamlined and it's ministerial. The issue with Eaton fire is many of those, the original building plans don't even exist anymore. I mean, these homes were built in the late 1800s, early 1900s, and so. Yeah, how do you go about property tax assessments or reassessments? That's a huge challenge, but I don't, David or Darcy?
Yeah, my only thought on it is, the assessor, I'm sure they're trying to figure out, well, are we reassessing just based, if the home was completely destroyed, is it just land value at this point, right?
Mhm.
That's all, you could fairly, I think, be reassessed. But if it was a partial, and then, by the way, there's probably some debate about the land value as well, because it's been an appreciating market largely. So yeah, I don't know if specifically what the rationale is in terms of what the assessor's thinking is, but our view is, and what Larry, I think Cosmo would say, is that you're going to be reassessing writ large these communities down to land value to the extent that they were decimated. And so that's again where that increment should be available. But I know it doesn't help you right now in terms of your situation relative to where it came out in terms of the current value. But there probably is going to be activity with the assessor in terms of making sure that they get it right. I suspect there will be appeals. I suspect there may be litigation, but they may be trying to figure it out themselves as well.
And as you mentioned, the real value is in the land, what we call the replacement cost, or the structures on top of the land. But that's why you see investors buying burnout lots, because they know the structure, it's the land value is what people, and we will have to look at reassessments and see how that goes. It's going to be political. For sure.
Absolutely. And just to add, that's not a surprise because there's also a gap in appraisals for mortgages as well. So there's going to have to be an overall adjustment based on the disaster that has occurred.
We saw the same thing in the Great Recession where folks wanted to reassess their properties based on what was happening in the general economy. And so we'll have to see how it's applied to the wildfires, post-wildfires as well. Question.
Hi there, my name is Jasmine. Thank you so much for the conversation today. Speaking about value, how long do you think it will take for these communities, Palisades and Altadena, to bring the value back where it was? Will it take 3 years, 5 years? Will it take until the homes are rebuilt again? And for those people who have standing homes in those communities, what are the thoughts? What's the advice? Do you hold on to those properties? Do you sell them now? Do you sell them 10 years from now? I mean, where is the value heading?
So yeah, it's going to take some time, obviously, to rebuild the properties. And as the survey suggests, the longer it takes to rebuild, the more likely people are not going to come back. We're obviously trying to preserve our neighborhoods. And there are some efforts to do that, but I don't know, David.
I mean, look, this is about time and patience. I think in 10 years, it's going to be awesome. It's going to be unbelievable. You will hopefully have a rebuilt community with new infrastructure. Landscaping will be taking hold. You'll have new homes. You'll have probably better ingress and egress, hopefully, in the event that there's another catastrophe. But I think it requires patience. And will I tell you it'll start to get better in 3 years? Yes. Will it even feel better in 5? Yes, but you will also be living through construction. You're going to be living through a zone where there's going to be a lot of construction activity on a pretty much constant basis. And then I think you're going to start to see in year 5 that, like you're gonna see it on the horizon where it's actually starting to, it's gonna feel like it's gonna get back to something resembling what it was. But I think you're really looking at minimally 5 years and probably closer to 10. But when you get there, it's going to be incredible. I think it's going to be amazing.
I do as well. I would make a recommendation along your lines of your question. If you intend to leave or you ultimately may leave just because of the time that it takes, if you can afford to, I would recommend rebuilding your home and then selling your lot, because then you will not lose nearly the amount of equity that we would leave on the table if you simply sold your burned out lot. And of course, we're gonna have to try to find whether it's philanthropy or low interest loans or whatever they may be to enable financially homeowners to be able to rebuild their homes and then ultimately resell them if they have to. But to sell out the burned out lot, you're just leaving a lot of money on a lot of generational wealth on the table. I think we have time for one last question and then we're gonna add that.
Can I just quick
sure.
follow up to that? So Darcy also had mentioned that fires are not going away, right?
Right.
So as
They're
you're
gonna get worse, in
rebuilding
fact.
homes, have you guys looked into, will there be things implemented like sprinklers outside by the roof or something to prevent homes from burning in the way they did?
I think, yes,
That's a
I
tough
think
one.
we are
Yeah.
gonna, the city and the county and the state may be adopting new codes for resiliency and defensible space. I think the insurance industry and the banking industry are going to basically drive that market in terms
Yeah.
of resiliency. I don't think it's necessarily gonna come, you would think it would be command and control regulation. More likely, it's gonna be driven by, if I want insurance, I'm gonna have to do these things, right? And it's not, by the way, resiliency is not just about building materials and defensible space. It's a big conversation. It's about, as Darcy mentioned, it's about forest management. It's about new sensor technology. It's about infrastructure, so that when fires happen, we make sure we have adequate infrastructure to make sure that there's water pressure at the hydrants, that there's plenty of access. So the resiliency conversation is a much bigger conversation, but it absolutely has to happen.
Right.
And
So
the building codes have already been upgraded since
Yeah.
certainly the Altadena fires, but I think Darcy, I don't know if you mentioned, there's something called Chapter 7A, which is in the building code,
Yeah.
which is a separate standard for structures that are built in high wildfire risk area. That may need to be expanded. And then as Darcy suggests, homeowners need to be able to go to the insurance companies and negotiate lower rates because they've done the hardening.
And remember,
we can stick around too if you have further questions, but one
Okay.
last question. and then we
Last
gotta wrap
question
it.
in the back.
Hi, I'm Marika with Green Economy, and I am impacted by the fires. And the thing, I just wanted to say three really important facts that I am living. One, once the insurance company started canceling everybody,
Yeah.
which I didn't know because I didn't get canceled, right then, as a community, we should have been thinking, why is this happening? Did they know that there was going to be a wildfire that's going to come and destroy everything? Because we didn't do anything. And that's a big problem, that we should have been cleaning the Santa Monica Mountains and doing whatever we should have. So right now, if insurance companies start canceling people, we need to react and not just put our hands down and go, oh, well, hopefully we're not going to have these high winds and this happen.
Great point.
That's number one. Number two, I think the current situation is these houses still have vents with the large scale netting. And that's where a lot of the fires went into the homes and burn the homes. What are we doing about that to retrofit all homes in all of these cities to make sure that this doesn't happen again? That's number two. And number three, I have now my house is standing. Fortunately, I actually did do fire prevention, so it did stand, but great, can't live in it. Most of my neighborhood's gone. The testing inside is like talking to 3 different people with 3 different approaches. So
Right.
having that uniform of how do you really clean so you can go back and feel comfortable going into your home and living there in that community, having your grandchildren come? That's still a big question. And that's something most people, and I also feel that the cleaners are completely overcharging for what they're doing.
Yeah.
There's a whole other part of that. But these are 3 things that are, or 4, that are right now very important that we focus on to prevent problems in the future.
Yeah, unfortunately, we have seen some price gouging, and it's not just with contractors and things. It's also the rental market for displaced people. There are some simple things you could do even now to fireproof your home, like as you suggest, go to Home Depot and buy a screen that is, where the embers can't go through. But yeah, we're gonna have to do all of that. There's also something called Zone 0 that's just about to come out, which is a defensible space between 0 and 5 feet of your home. So the wood fences that are attached to your home, the wood mulch that's right next to your home, and Yeah, we're gonna have to adopt all of those things in California. And I think Jerry's gonna give us the yank here.
We're getting the hook.
Yeah.
So please join me in thanking our panel. Obviously, a difficult subject and a difficult time, but LA certainly will rebuild.
Absolutely.
And thank you all for staying till the bitter end. But before you leave, I do need to thank our sponsors, the principal level RSM and Yamava Resort and Casino at San Manuel, platinum level law firm of Alan Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Mercury Insurance, and University Credit Union. At the gold level, Alaska Airlines, Avenue Insights and Analytics, Bank of California, California Steel Industries, Hub International, Leap Development, PNC Bank, Robert Half, and SMBC Manu Bank. At the silver level, Comerica Wealth Management, Marsh McClellan Agency, US Bank Private Wealth Management, Wilmington Trust. At the bronze level, Accutive Security, Federal Home Loan Bank of San Francisco, Hanmi Bank, HDR, PCL Construction, Port of Long Beach, MBK Real Estate Companies, and Shawmut Design and Construction, and the Bruin level, Clune Construction, GCX, Illy Commercial Real Estate, and JLL. Sponsors, we are most appreciative of the fact that we put on these programs because of you. So many thanks. Thank you all for coming. The next conference is this is June, is in October. A lot's going to change.
Oh, yeah.
So stay tuned and we'll see you back in October. Thank you.
Great.
Awesome.